So the market is choppy today.
Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 44, a complete AI creation platform. Describe what you want, and watch it.
Lean into it and say they're always true. I think people have overhired over the last 5 years coming out of COVID. They're restructuring to drive operating leverage in the business. That being said, everybody, including us, across every single function in the enterprise at Workday, we are leveraging AI. We're getting operating leverage, and we're using those operating leverage in those cost savings to invest in the business to drive growth for the company, also for our employees. We don't believe AI is going to replace humans. We think it's going to drive a step function change in human productivity, and we're going to amplify human performance, not replace it. So I think, and definitely me, Julie, I have a different view that we're going to, take out 20, 30, 40, 50% of our employees because of AI. I just don't see it. We're going to actually amplify human potential, not replace it through the use of AI.
Maybe I can channel your VC background a bit here. Some of the valuations we are seeing on private companies tied to AI, even in OpenAI, I mean, they're not making any money, but they're signing big deals. Do things feel frothy to you?
Listen, I'm not in the venture business. I'm still a partner at Sequoia and help them when I can. But I do think, valuations are frothy. I do think over time, that's not uncommon when you have these, big tectonic shifts and there's a massive amount of private capital going into these businesses. But I think that will kind of play out over time. And I think it will be a rich opportunity for folks like Workday to look at some of these companies when they decide to go raise another round. Maybe their valuation expectations curious. We've made 5 AI acquisitions, Brian, in the last just under 2 years, and 3 of them have been in the last, if you will, 3 months. And I think we look for companies that have great value, bring us great technology, bring us great founders and people, and they fit adjacently into our go-to-market strategy so we can amplify their growth as they become part of us.
The early bird catches the gains. This is Morning Brief Market Sunrise. Live from London, we deliver an early read on global markets, from overnight action in Asia to real-time sentiment across Europe's major trading desks and a live look at US futures. We cover the stories to help you, the individual investor, get the edge with actionable financial information and unbeatable context. So grab that coffee, tap in, and let's own the morning.
It's 9 o'clock.
Minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets now. Taking a look at the major averages, we are seeing a rally take hold, although it's a modest one when it comes to the Dow, which is up just about 41 points. We have earnings kind of doing the push and pull thing today. The S&P 500 up about 0.4%, and the Nasdaq, despite the declines in Tesla, is up 0.6%. Another cohort of stocks that's rising today, quantum computing ones. They're rising on a Wall Street Journal report that several companies are in talks to give the Commerce Department equity stakes in exchange for federal funding. Joining me now at the desk to explain why the U.S. might want a piece of the quantum business is Yahoo Finance tech editor Dan Howley. And it's really interesting. I talked to Alan Baratz, who is the CEO of D-Wave, one of these quantum computing companies, just last week. And he said China is ahead of the U.S. when it comes to quantum. And he was calling for, if not this kind of investment, this kind of, interest and a push behind it in the U.S.
Yeah, I mean, we have seen an increase in quantum investing from the likes of Microsoft, Amazon, Google. IBM has been in the quantum space for, it feels like forever. So you can't count them out when it comes to this idea of quantum. But yeah, this is kind of... It's not necessarily the future of all computing. It is a future of computing. I think the thing that people might get wrong when it comes to quantum computing is that they're going to be, the new CPU, your central processing unit, your regular computer, your smartphone. The way that some experts I've spoken to have phrased that is like taking an F1 car to the supermarket. Like it's impractical, it's unnecessary. These computers are also massive. When you look at them, they don't look like your standard laptop.
Right.
These are in a facility. They have to be shielded from the outside world. Things like hydrogen molecules from the air can mess up the calculations that they're doing. They're dealing with subatomic particles that are called qubits. So when you look at a regular CPU, it talks to the different parts of the computer using ones and zeros. It's called binary. It's the base computer language. And then everything else kind of builds on that. So when you swipe, eventually that's translated into a 1 or a 0, and it's giving the processor instructions, or and vice versa. These qubits exist as ones and zeros at the same time. So what that allows is for them to do parallel processing, and essentially that means that you would be able to do calculations that would have taken classical computers potentially tens of thousands of years to complete. So it's a powerful technology, and the folks that I've spoken to in the past have said it can influence everything from healthcare to sciences of materials, coming up with new types of structures, things along like big questions, right? We're just not there yet. And so it's a matter of researching it. And there are folks who will say, well, it's right around the corner. It's been right around the corner since like the 50s. And so there's constant advancement in it for sure, but it's not to the point where it's like, all right, well, tomorrow I'm going to be able to walk down the hall, flip a switch, and turn on a quantum computer. But it is very important to get into because, on the world stage, if you don't want to cede the lead in any kind of technology,
right,
you need to make these kinds of investments.
Well, I'm sure we're going to keep talking about it. So, Dan, thank you very much for giving us a little bit of a primer there. It's hard to wrap your head around. Thank you so much. Appreciate it. Well, the largest alternative investment manager, Blackstone, reported strong third-quarter distributable earnings. They rose to the tune of 48%, though we are seeing the shares down by about 5% today. But let's talk through the numbers with Jonathan Gray, Blackstone president and COO. John, thanks for being here.
Great to be with you, Julie.
So let's talk about those distributable earnings, which, as I mentioned, were up 48%. Does this feel like you've hit a turning point, we're past a turning point, and things are just going to improve on that front from here? Or is it going to be sort of lumpy going forward?
Well, I would say there are a number of really positive things that are happening. One is we've made some great decisions on where we invest capital. We focus pretty deeply in digital and energy infrastructure, and that is paying off for our customers. It's leading to more inflows, $54 billion in the quarter. That's the fourth quarter in a row we've had more than $50 billion. And that leads to these strong earnings. But as we look forward to your question, we've got a number of things that make us feel good. One is we've got this cyclical upturn in deal activity. As rates have come down, spreads have come down, as the IPO market has reopened, the deal dam is breaking, and that's very helpful for our business, and that should provide support to earnings going forward. And then we have these big secular tailwinds. We've got areas like insurance and wealth. We've got geographic areas like India, areas like life sciences. All of this gives us a lot of momentum as we look at our business going forward. So I would say, yes, we've got a bunch of confidence as we look into 26 and beyond.
And we're going to dig into some of those areas in a moment. I want to linger on this stock action for just a moment. And I know, you're focused on the long term, not just the one-day action. But I have been trying to dig into where the disappointment might lie, because on the face of it, the numbers look strong. And one analyst pointed out to me that management fees might have been a source of disappointment here, and that there was perhaps some confusion around the guide on management fees. Can you give us a little bit more color on that?
Yeah, I think, it's really hard to focus on markets and sentiment. And I would say in general in markets, right now there's a lot of skittishness. There's a lot of concern around what's happening in private credit, which we think is much sounder than some of the headlines. And so you're at a time in the world where people are glass half empty, and you get these sort of sell-offs. On the management fees specifically, I think we were up double digits in the quarter. Our AUM was up 12%. We see a lot of momentum in our business across all three of our channels here, managing capital for insurance companies, for individual investors, and institutions. So I think it's really hard to react day to day. I would tell you, most times I think the stock's going to be up. It tends to go down, and it's inverse. And so reacting day to day is hard. What I can say is over the last 5 years, the stock has delivered a 3.5 multiple in total return for our investors. And when we look forward, given the strength in the underlying business, we feel quite good.
Fair enough, Sean. You mentioned credit and some of the skittishness. You guys, your credit assets are above $500 billion for the first time, at $508 billion. There has been concern about risk in the market, but I want to ask about something slightly different, which is more valuations in that private credit market. And I'm curious if you think valuations there and returns there have perhaps peaked, given that, we're seeing rates go lower and other factors.
Well, I think on valuations in private credit, it's different than equity. As long as a credit is performing, you're generally carrying it at or around par for that loan, because these tend to be floating rate loans. So it's really only a valuation issue if you have significant credit issues. That's not something we're seeing broadly in our portfolio or frankly at the market at large. I think the second part of your question is what happens as rates decline. And yes, there is a reality when you have floating rate products that your dividend yield is highly correlated to where the Fed sets rates. But I think what's really important to keep in mind is the premium that private credit can give versus what you see in the liquid market. So because of the farm to table model we have, basically taking investors' capital and bringing it right up to borrowers, you avoid a bunch of those securitization, origination costs, and in that process, you drive higher returns. And interestingly, as you bring down rates, the relative premium on a percentage basis from private credit actually goes up. So I think you're right on the absolute return concept, but on a relative return, that's where we see an enduring premium for investors of ours in private credit.
Okay, fair enough. Still, we'll obviously continue to focus on that private credit market. You guys are huge in data centers and the AI investment. And I know you've talked a lot about this area recently. As you know, there's also a lot of debate about whether there is a bubble there. So the valuations conversation is definitely relevant when it comes to data centers. Are you applying a sort of different lens to those investments than you have been? Are you scrutinizing them a little more closely?
No, I think we've been pretty disciplined the whole time. When we look at these, either on the equity side as an owner or when we finance them, we're thinking about the same things. And the keys are we signing a long-term lease with a very large investment grade company? And that really provides the ballast and safety. So if one of the largest companies in the world with a $1 trillion to $4 trillion market cap, strong investment grade rating, signs a 15 to 20-year lease, you have something of incredible value in addition to the hard asset you built that's got access to very valuable power. So that to us seems like a sound way to do this. We continue to be disciplined. We're not, these are not condos in Miami where you build them speculatively. These are long-term leased, pretty conservative assets in that sense. And so we like this business because it provides the foundation for what's happening in the AI revolution. AI is going to bring a ton of productivity to businesses, to all our lives, but it needs this foundation. It needs chips, it needs data centers, it needs power. We've leaned in really hard in data centers, also really hard into energy, and we think that's a really sound way, the picks and shovels here, to support this major technological change.
John, you made some comments recently about AI that I thought were really interesting, where you talked about there's so much focus on valuations and less focus on where AI could be disruptive to existing industries. And on that front, there was a report that OpenAI has hired some ex-investment bankers in order to train its models to build financial models. And so I wonder what your thoughts are on your business itself, on the financial business being disrupted by AI.
Yeah. It's a great question. I would say that that discussion around disruption is so important because everyone's over here looking at bubbles. They're not looking over their shoulder as industries change. And I would say at our firm, I think when you think about the investing function, these tools will be super helpful. And they're already helping us summarize data, come up with thoughtful questions. I don't think they're going to displace our analysts and associates anytime soon, but they'll be very helpful. There are a lot of functions here, though, where we're seeing real productivity gains. If you think about Claude Code and our engineering folks here doing software work, that's very helpful to make them much more efficient and productive. Our video and content team using these AI tools, also helpful. In the legal area, in places like marketing compliance, we're able to use these technologies to, again, make our people much more productive in what they're doing. So I think we're going to see across the economy, including here at Blackstone, a bunch of changes. Some of it will take time, but I think there'll still be plenty of jobs. It's just going to be this really enhanced productivity in a number of areas.
John, finally, I want to ask you about probably my favorite comment on the call, which was somebody asked you or asked the executives how you're sort of approaching the retail channel, how you're branding Blackstone, and were you going to have a Blackstone Stadium anytime soon? Which you guys said, no, we're probably not going to have a Blackstone Stadium. But I do wonder how you are approaching that branding question, especially as you drive more and more into that retail channel.
Well, this is a hugely important area. Christine Anderson, who runs our corporate affairs, oversees our marketing. We spend a lot of time talking, as also with Steve Schwarzman, about how we can position this firm, how the world can see us. And we are moving, as we have really now over 20 plus years in the wealth space. We're broadening who our customers are. And reaching them is obviously different than when you have individual institutional meetings. And so it's critically important that we partner with the large financial institutions and distributors and wealth managers at the home office. Really important. We build relationships and partnerships with financial advisors here in the US and around the world, and then ultimately with underlying customers. But this is still a pretty targeted sale. It's not for every consumer out there. So I think you'll see us show up in a relatively small number of places where we think there are a large number of potential customers. I think this is an important part of our business, and our brand matters. The good news is we understand at the end of the day, it's all about performance. We've got to deliver for these customers. We've got to deliver for financial advisors. And then it's about growing awareness and doing it in the right way. So you will see a little more Blackstone out there. I don't think it's a stadium anytime soon.
Okay. All right. Well, we'll keep asking you about it. Maybe things will change. John, thanks so much. Good to see you.
Thank you so much. Be well.
Take care. You too. Much more markets action coming up. Stay tuned. You're watching Market Catalyst.
The first thing, of course, is AI. It's no surprise that high quality data continuously collected is what's required to make really accurate predictions and inferences about your health. And that's an area of investment that we've been investing in for several years, but I think we really want to take it to the next level. The second thing, of course, is international. Today, we're largely a business focused in the United States. But we want to take our business on the road and expand around the globe, and we expect to see that drive growth for the next several years. And then the final thing, of course, is we are mission driven, and our mission is to make health a daily practice. What we expect to be able to do is to start to work our way into the healthcare industry. Today, we work with insurers. In the future, we expect to work with insurers and providers and clinicians, and expanding our product platform and technology platform to work in hand with traditional healthcare is a big part of our investment going forward.
So, Tom, put some of that together for me, in particular the AI and the healthcare piece, because ideally, one would see a future where you could use a tool like an Oura Ring or whatever tracker you're talking about to be predictive, right? To say you're at risk for a heart attack or what have you. Here's the signs. Here's what you need to do. How far away are we, or are we already there, in terms of that kind of functionality?
So today, for example, Aura can look at your biometrics and make a prediction about your health status in a couple of days. The feature is called Symptom Radar. It looks at several biometrics, looks at what's normal for you, looks at the trends in your health, and can say something like, hey, you're showing major or minor symptoms that are expected for you in the next couple of days. And that's a very short time horizon prediction. This has been incredibly useful for lots of people. I used it personally to help stay healthy when I'm traveling. I'll take a day and rest and break so that I can recover without getting sick. But it's really surprising and powerful how accurate it can be. You think you don't feel any symptoms at all, and then 3 days later you're on the couch watching Netflix surrounded by Kleenex. This kind of prediction, that's a short-term prediction. But the density of data and the quality of data that we can collect, including data from the ring, but also data from outside, things like I'm wearing a glucose monitor right now, or we recently introduced blood biomarkers where you can actually sign up and get those tests taken, and then we'll bring them together inside of your Aura experience. Adding all that data together lets us make longer-term predictions. And I think the way to think about this is that it's almost like a doctor in your pocket. You've already got a supercomputer in your phone. You've got a device on your body that's measuring, kind of clinical grade data on a constant basis and looking at you overnight, which means your body's at rest. So we get a very good signal, and then feeding that information to a machine intelligence, which is looking over you. And it's not just the doctor, in your pocket that's sort of saying, hey, something's going to happen to you, you got to watch out for. It's also trying to steer your behavior in kind of that preventative medicine way, where it's trying to influence your behavior to help you live a longer and healthier life. AI is the foundation of all of that. And if you think about medicine today as being practiced on the averages, and you go to the doctor once a year, the difference is that this AI will be personalized to you. It'll be custom to you. It will know your data, your context, your genotype, your phenotype. In the future, that's the future of medicine. And it's not only personalized to you, but it's also predictive and can work with your clinician to help them understand what's going on with you, right, like a co-pilot for your doctor.
Tom, I have so many questions for you. I'm curious what you make of the sort of criticism of this type of hypervigilance and transparency of the data, that it actually increases anxiety, can increase, sort of overdiagnosis or misdiagnosis in some cases, because you are people can obsess over having all of this information.
Philosophically, I think our approach is that we want to recede into the background. We don't want to be reminding you every day of your mortality and to create some anxiety. We try and make the experience be as low impact as possible. I think that's actually partially because we don't have a screen on the device. It just sort of is there monitoring you like a guardian angel in the background. But when you need it or want it, it's available to you, and you can investigate it at your leisure. Now, that being said, there certainly are people who I think become overly obsessed. I don't know if your husband talking to you every morning about his sleep score qualifies, but the point is that the information is power. And that power, you can use it to live a healthier, longer life. And I think that's incredibly important. The idea is to give you agency in your health journey. And I think this is a trend that's been going on, for decades, as people have learned more and more and gained more access to health information. Scientific papers are available on the internet. Everyone can become an expert. Now, that being said, we don't want you to be obsessed. If you are obsessed, please, take the ring off. Give yourself a break, because one of our core values is that you should live a life of balance. And balance means, finding the right, set of circumstances for you in your life where you are. We want to meet you where you are right now and give you the power to drive your own health journey and not be just a passenger on the bus.
Some breaking news crossing the wire. President Trump has pardoned Changpeng Zhao, the convicted founder of the crypto exchange Binance. The Wall Street Journal reported the president pardoned CZ, as he's known, on Wednesday. This comes following months of efforts by CZ to boost the Trump family's own crypto company. Trump recently indicated to advisors that he was sympathetic to arguments of political persecution related to CZ and others. That's according to the Journal. White House Press Secretary Caroline Leavitt said that Trump had, quote, exercised his constitutional authority by issuing a pardon for Mr. Zhao, who was prosecuted by the Biden administration in their war on cryptocurrency. A pardon will likely pave the way for Binance, the world's largest crypto exchange, to return to the U.S. That's after the company pleaded guilty in 2023 to violating U.S. anti-money laundering requirements and was barred from operating here. Binance did not immediately respond to the Journal in a request for comment. We do know, of course, very broadly that this administration has been a much, much friendlier one to the cryptocurrency industry.
Welcome to a new episode of the Opening Bid Unfiltered podcast. I'm Yahoo Finance Executive Editor Brian Sizey here at the NASDAQ in Times Square. And like I always say, this is the podcast that will make you a smarter investor, period. And that to that end, you're going to get a lot smarter after this episode. Joining me right now is Richard Thaler. He, of course, won the 2017 Nobel Prize in Economic Sciences. He wears a lot of hats, Richard. He's also the Distinguished Service Professor of Economics and Behavioral Science at the University of Chicago's Booth School of Business, and he manages money. Fuller and Thaler, about $30 billion in assets under management in small caps. Rich, I mean, how do you even have time for me here coming on this episode?
You know, Monday the golf course is closed.
No, fair enough. And I should also mention he's out with a new book, and that book is called The Winner's Curse: Behavioral Economics, Anomalies Then and Now. Richard, let's start with the book. You've been at behavioral economics for some time, many decades, seen as a pioneer in this field. You know, what made you write this book now?
I will say it's a weird book. There was a version of this book that was published in 1992, and it was based on a series of articles I wrote in an economics journal under the heading Anomalies. And anomalies are obviously things that we don't expect. So if you saw a bear that had stripes like a zebra, that would be an anomaly. And I published these once a quarter in this journal, and they were pokes at the economics establishment, saying, look, see this? You guys say this can't happen. Here it is. And when I had enough, I kind of stapled them together and published them as this book. And the book was about to go out of print, and the publishers said, hey, you want to freshen it up or something? And maybe stupidly, I decided to do something more ambitious. And I recruited a young colleague of mine, Alex Emis. And we took some of those old columns and some others I wrote and started with those, and then add an update to each one and say, well, is this true? Does it replicate? Or were we just making it all up?
What, for those not familiar with behavioral economics, how would you define it?
So it can only be defined in comparison to non-behavioral economics, which the fact that we need such a term is weird, right? Because what other economics could there be? Presumably, like even now, all the trades that are going on in the background there are people, even if and maybe people wrote programs, but there are people. So, but starting after World War II, economics became increasingly mathematical and formal, and the easiest models to write down are of people that are really smart and really selfish. And because economists are not geniuses, they and are lazy, they write down models that are the easiest ones to write down. And the fact that means the models are wrong, because the people aren't geniuses and they're not selfish jerks, and they have self-control problems. So if we add a little psychology, the math gets more complicated, but the field gets less wrong. And so that's the enterprise that I started 40 years ago. And this book is kind of an update of where we are.
How has the profession changed relative to 40 years ago?
Well, it's a great question. We did not cause a revolution, in the sense that if you open up an economics textbook, it doesn't really look very different. What's the revolution is, there are now behavioral economists in every top economics department and business school around the world. There are behavioral economics papers in every top journal in every issue. So young people, well, and even not so young, but I mean, I always say that I didn't change anybody's mind. So the people my age didn't change their views at all, but I corrupted a lot of young people, like Alex Emis, my co-author. And so that's where the field is now. It's no longer considered to be ridiculous to be assuming that agents are less than fully rational and that markets are not completely efficient. But the field hasn't quite figured out what the standard thing is.
You brought up a good little nugget there, Richard, and it's something I actually had down to ask you, because I'm fascinated to get your take on this. I think a lot of investors have become trained to think that markets are efficient. What a stock price reflects is the best available information. It's a predictor of the future earnings power of a company 6 months to a year out, or however you want to look at it. But that doesn't sound like how you view things.
Yeah, so the efficient market hypothesis is a phrase created by my colleague at Chicago Booth, Eugene Fama, and sometimes golf buddy. There are really two components to it that you alluded to. One is that I call it the price is right. So stock prices are a correct assessment of intrinsic value somehow measured. And the other is, say, the no free lunch component, that you can't beat the market. And the latter is, I would say, approximately true. I say that even as a principal in an active money management firm. It's possible to beat the market, but it's hard. Most mutual funds fail. Almost all individuals fail. So it's probably a good idea to start with the idea that you're not going to beat the market any more than you're likely to beat Scotty Scheffler in a round of golf. You're competing against pros, and the pros aren't beating the average. As to whether prices are correct, I would say there's virtually no evidence to say that that's true, and lots of evidence to say it can be wildly wrong. And we've had bubbles going back to tulips, and, in the relatively recent lifetime, we had the tech bubble in the late 90s. We had the financial crisis, and more recently, then we have Bitcoin. I don't know what we want to think of that. Then, post-COVID, we've had meme stocks. It's still the case that some of these stocks, the prices seem incomprehensible to me. But as I often like to say, I can be very confident that a stock price is too high, but that doesn't mean it won't go up.
Well, then how should one go about building an investing plan? A lot of folks, they love to pick stocks. They're all looking for the next NVIDIA that's going to go up over 1,000% over a 5-year time frame. What do you say to those folks that want to buy stocks and they think they could beat everyone?
I would say that if you want to buy stocks as a hobby, go for it. But do it with a sensible amount of your portfolio, and do something sensible with the rest.
So is a better bet to go with ETFs that just track the market, earn 10% over time, and call it a day?
It's very few individual investors will do better than buying ETF index funds.
Interesting. All right, hang with us, Richard. Go ahead, Richard. Go ahead.
Yeah, well, and the ones that are trading, the more they trade, the worse they do.
Yeah, that's true. Hang with us, Richard. We're going to go off for a short break. We'll be right back. Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts. All right, welcome back to Opening Bid Unfiltered here at the NASDAQ in Times Square. Having a fun chat. Richard Thaler. Richard, I can't think of a better person well situated to weigh in on this AI bubble debate. From my vantage point, I get the excitement over the AI trade, the AI infrastructure build out around the world. I don't think we're at bubble levels. What say you?
I don't have a professional opinion about that. And I don't know how we would know. You know, let's go back to the late 90s. And there was what looked like a bubble. You know, if you added .com to the name, the stock price would go up. Now, and NASDAQ fell by 2/3, something like that, after 2000. So ex post, it was obviously, well, ex post, it looks like the people who said it was a bubble were right. Who knows? And now that's not to say there weren't winners. So if you were betting on Apple and Microsoft and Amazon, those bets turned out to be right. If you were betting on pets.com, you lost all your money. And so is there a bubble in AI? I don't know. There will be winners and losers. We don't know which those will be. And we don't know how big AI will be in terms of economic returns. I like to compare it to the iPhone. The iPhone is, for me, the biggest technological change in my lifetime. I have a computer in my pocket. I have access to all the world's data and information and GPS so I don't get lost. Right? That was life-changing. Will AI change my life more than that? I mean, AI is already driving my GPS, right?
And it's tracking your yardage on the golf course too, Richard.
It is. It says my drives are about 280.
That's
right?
That's pretty good, man.
Yeah, that's a blatant lie. I'm only adding 100. So our life has been changed by technology. What the change of adding AI will be, I don't know. I don't see how anyone knows. There's obviously huge potential, but I don't see how we know what the economics is. Let me give you an example. Back in the late 90s, I kept saying, I don't see how Amazon can ever make money.
Yeah.
Now, I think I was right. The idea of selling books and losing money on each one seemed like it wasn't a money market then, a profit opportunity then. It still doesn't, right? Who knew the cloud?
Yeah.
Right? So will one of these or one or more of these players figure out a way to make a lot of money on this? I don't know.
How do you, Richard, how do you know, how could one spot a bubble? Like, what are some of the characteristics?
Well, you know, you can start with some fundamentals, but when we're at these early stages where there's essentially no revenue, you know, back in the tech bubble when they switched from PE to price to revenue, and for a lot of these companies, there's not even revenue, so it's impossible to make a judgment now. What are the revenues going to be, and how competitive are the markets going to be? If somebody gets a monopoly or significant market power, if there's an Apple or a Microsoft or an Intel, you know, going back 20 years, then they're obviously going to make a lot of money. We don't know which one of those it'll be. And You know, if you think another ancient example, video stores, right? There was a boom. Every mom and pop started a video store. They got driven out of business by Blockbuster, which became a monopolist. Then came along Netflix. They tried to sell their business to Blockbuster. Blockbuster said no. And then Blockbuster went poof. Now, Netflix didn't capture all the market because then Amazon Prime, right? There's lots of competition for that. So even if you get a monopoly, you're not safe if somebody else comes along.
This has been an amazing year for the stock market, Richard. There's been every reason for this market to not be up double digits. Tariffs, policy uncertainty, slow growth overseas. What's the psychology that has sent this market up to these levels? And the level of resiliency, I think, has surprised a lot of folks. And it has forced them to play catch up in many respects.
You know, if I knew, I would tell you. I don't understand it. It seems like, of course, the market, we talk about the market as if it were a thing. It's a voting machine. And I think there are a lot of people, FOMOs. I don't know. I don't know how we can ignore tariffs and policy uncertainty. The only story I can tell is market participants think there's a bad dream and it's going to go away. So the kind of taco model that Trump is going to come to his senses and we're going to wake up and it's all going to be fine. There is not a single economist I know who thinks that the tariff policy is sensible. And, University of Chicago runs a poll I'm not saying just people I know. There's a poll of 50 well-known economists across the political spectrum. They all think this is bad. So how the U.S. stock market is ignoring that, I don't know. Maybe they know something I don't know.
Lastly, Richard, before I let you go, we always love to get a hot take from our guest at the end. Nothing planned, just off the cuff here. Who is your favorite investor and why?
Well, you got to go with Buffett. Long-term track record, and
a little bit of a stock picker, Richard. A little bit of a stock picker.
Yeah, a little bit of a stock picker, and a bit of a sweet talker. He's got a lot of widows to sell him businesses at good prices. If they want to come talk to me, I'm almost as old as him.
Fair enough. It was good to finally talk with you, Richard Thaler, author of the new book, co-author of the new book, The Winner's Curse, Behavioral Economics, Anomalies, Then and Now. Good luck with the book. We look forward to staying in touch. Appreciate it.
Okay, great to talk to you.
All right. That's it for the latest episode of Opening Bid Unfiltered. Like I always say, hit us with all that love on the social media platform and YouTube. I love all the feedback. It makes me better at doing at these interviews. So keep them coming. Hit us with those ratings. I appreciate it all. We'll talk to you soon.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor.
Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk.
I'm Elizabeth Core. Welcome to The Big Idea.
Welcome to Yahoo Finance Sports Report.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts. Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
It's 10 o'clock.
It's time for Yahoo Finance's Market Minute. Stocks looking to regain their footing after Wednesday's slide, shaking off disappointing earnings from Tesla and IBM. Mortgage rates hitting their lowest level in over a year. The 30-year fixed down to 6.19% from 6.27% last week. That's according to Freddie Mac. T-Mobile topping Wall Street's estimates in its third quarter and adding a record 2.3 million postpaid customers, a million of which were to its phone service. Analysts were expecting just 852,000 new mobile customers. Still, those shares are down today by almost 5%. And Union Pacific topping profit estimates, a 16% year-over-year rise in volumes in coal and renewables. That drove the growth as the company navigates decelerating freight volumes industry-wide. Union Pacific expected to submit papers for its $85 billion mega merger with Norfolk Southern as soon as the end of November. And that's your Yahoo Finance Market Minute. Scan the QR code below to track the best and worst performing stocks of the session. Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Tesla dropping after a plunge in profit. We'll have more coverage ahead. Plus, we'll preview what to expect from the rest of the Magnificent Seven earnings. And we'll discuss competition in the wireless space with the COO of AT&T. First up, let's take a look at the major averages here, though, this morning. We are seeing, we went from a little bit of a decline to a little bit of a gain here. So right now, the Dow is up about 54 points. The S&P 500 up about 1/3%, and the NASDAQ is up about 0.5%, being driven a lot by the earnings-related news here this morning. But of course, there are some other important moves to note here this morning, namely what's going on in crude oil futures. And this is after the administration imposed new sanctions on the oil giants Rosneft and Lukoil. That raised some questions about supply globally, and so we're seeing crude oil futures spike a little bit here today. That also means that energy stocks are the best performers in the S&P 500, so that's helping support some of the gains we're seeing today. 1.4% is the gain that we're seeing in the XLE. Industrials also doing well today on the back of some earnings reports. Materials higher as well. Consumer discretionary is the laggard in today's session. If we go into the Dow here, and kind of equal weighted to see what we've got on the move. IBM out with its earnings after the close yesterday. Those shares are down 4%. We're going to have some details in just a little bit. Counterbalancing that to some extent, Honeywell on the other end of the spectrum up by 5% after its earnings report. So you see here the sort of balancing act that we get into during earnings season. Similarly, you look at the NASDAQ 100 today, and most of large cap tech is in the green. Not in all cases by a lot. Apple is only marginally higher, but most of that we're seeing in the green as the NASDAQ overall rises today. There's one big exception that we should note, and that, of course, is Tesla. Those shares are off by 3.5% after that company's miss on earnings. So that, to some extent, holding back gains in the NASDAQ, but the NASDAQ overall is rising. So let's talk more about that one stock, shall we? Those Tesla shares lower after it reported mixed earnings for the third quarter Wednesday. The company did have record vehicle deliveries. It had strong sales in the period, but those profits were hit by tariffs and lower emissions credit revenue. CEO Elon Musk promising an expansion of the company's robotaxi initiative and touted its progress in developing its Optimus robot. He also took time to ask shareholders to vote in favor of his $1 trillion pay package. For more on Tesla and big tech earnings, Dan Ives, Wedbush Securities Managing Director and Global Head of Technology Research. Hey, Dan, how are you?
Great to be here.
So,
Good to see you.
I was just looking at some of the numbers for Tesla, and I know that people don't buy Tesla because of the cars, and we've had this discussion before. Cars still account for 3/4 of this company's revenue, Dan. So, yes, if you're looking at the robo-taxi future, I guess with Tesla, it's always a timeline question of when all of that stuff is going to actually start to be more meaningful.
Yeah, look, I mean, Julia, if you look, demand stabilizing, relative to what we've seen, especially over the last year. And China, I think that's an uptick. So that is important just in terms of the car business and even margins upticking. But the reality is, me and you've talked about many times, like, this is going to be a golden chapter for Tesla in terms of autonomous and robotics, the AI roadmap. That's why you own the stock. That's why I think this thing ultimately is a double, over the next 12 to 18 months. As it plays out, robotaxi scales and autonomous, it's going to be the best, ultimately when it comes to consumer, best application out there.
Okay, Dan, break this down for me. Explain this to me. How do they make money from autonomous? Because right now they own all the robotaxis, right? So they're making whatever small service revenue there is from those cars. But then ultimately, what does that profitability picture look like? And again, when can investors expect it?
Mm-hmm. Yeah, look, and obviously when, right? Like, that's the big question. Look, I think first, if you focus just on 1 year out, from NVIDIA to Microsoft to Apple, I mean, we go to every tech company out there, I think you've missed that transformational move, right? For Tesla, you got to look out 2 or 3 years. And ultimately, look, can you get to 500,000, 1 million vehicles out there? That essentially, it's going to be a cyber cab, it's going to be a robo-taxi network.
Right, but do they own that network, or does someone else own that network? And what's the profitability of that network? Because a robo-taxi, at least as my understanding, is not a cheap thing to run, right?
Mm-hmm. Look, they're going to own that network. I mean, right, it speaks to what I view as probably the biggest competitive threat to an Uber. If you look out over the years, what Tesla's going to do here. And remember, there's going to be their own network. And then if me or you, if we have a Tesla and we're at work, we could ultimately put that Tesla into the network. So while we're at work, it's actually giving rides out, right? And then ultimately, that speaks to the broader effect that's going to happen here, is that this is laying out what's going to be this biggest chapter of growth ever. So you can't just look at over the next 1-2 years what earnings looks like. I could argue there could be growth power 12, 15, 20 hours earnings when you look out. And that's why I think this is a stock that should be green today, not red.
There's a lot that has to go right between now and then. The other thing that has to go right is the Optimus robots, which Musk talks about. But again, who's the customers for these robots? I've talked to robot people who say the real applications are not going to be in humanoid robots at all. They'll be in other functional robots.
Yeah, I mean, look, I think first on the factory side, that's clearly going to be an application when it comes to on the robotic side. But the biggest thing is going to be on the consumer. I mean, it's our view, and we're not talking 10 years now. We're talking 2, 3 years, that it's going to become commonplace to have robots in houses. And I think that's the important thing. That's what Tesla's going after.
Dan, for what? What are these robots in our houses going to be in 2 to 3 years? You're telling me you're going to have an Optimus in your house. What is it going to do?
And again, that is my view. It will be doing the wash. It could be taking the dog out. In other words, it's going to be doing functions that in a house, these are going to become more and more commonplace over the next decade. And Tesla's going to own that robotics vision as well as the autonomous vision. That's why you're paying Musk $1 trillion. In terms of, if he hits all the goals. That's why Musk is the most important asset for Tesla. It's the future. And what I view as a physical AI play, there's NVIDIA, and then there's Tesla.
And just quickly, Dan, you're predicting that he'll get approval for that pay package?
Oh, yeah. I think that's going to overwhelmingly be improved. Because, look, it just comes down to, he is the only one that could lead Tesla into this chapter. And everyone understands as an investor, You need Musk, wartime CEO, locked in, set the high bar relative to the targets. Look at the last one. He hit all of them.
Dan, I want to switch gears and look ahead a little bit to next week when we're going to get a lot more earnings. Let's start with Apple here. As you know, there's a lot of chatter that there's pretty good uptake of the iPhone 17. That's not going to be in the quarter that they're about to report, but how is that going to feed through into maybe what we hear from Apple?
It's a surprise upgrade cycle. I mean, that's the reality, right? I mean, no one expected it was going to be, including, even myself, no one expected it was going to be this strong. So that's going to be clear, good in terms of obviously going to holiday season, in terms of guidance. China, I mean, we talk about with Tesla, China now actually goes to a tailwind for Apple from a headwind. And that's important because you go back to the last few months, New York City cab driver, bearish in Apple. Now you set up for what I believe is going to be the Apple Gemini partnership on AI. That's how you're going to get to what I think in a year from now is, $325, $350 stock.
And then, Dan, finally, we're also going to hear from Microsoft. And I'm curious, as we look at the sort of hyperscaler wars or cloud wars, if you will, do you think that Amazon's outage is going to allow Microsoft to grab a little market share?
I don't think so, because I think that continues to be sticky. But I do think, look, when it comes to Jassy and Amazon, they're playing catch up relative to enterprise, what Microsoft's doing, because they're in pole position on these enterprise AI workloads as that stays within that sort of Redmond base. Now, Google has clearly had massive growth, and I think you'll see it again in terms of all of our checks, what we'll see from GCP this quarter. Look, but for Amazon, that's the opportunity. And I think that's right now the big focus to make sure that they're not on the outside looking in.
Dan, good to see you. Thanks so much.
Order canceled.
And by the way, we'll be talking much more with Dan Ives and lots of other tech and AI experts at Yahoo Finance Invest. That is streaming live on November 13th. In the meantime, we got much more markets action coming your way. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching Tesla, Zion, and Moderna. First up, Tesla. Shares under pressure after the company reported mixed third quarter results, but Morgan Stanley's Adam Jonas sticking with his outperform rating and $410 price target, saying the next big catalyst could come from Tesla's robotaxi push. In a note to clients, Jonas called Tesla a forgotten AI stock, arguing the market is missing its long-term potential in robotics and autonomous tech. He believes Tesla could remove safety drivers from its robotaxi fleet in Austin as early as next quarter, a move he called a really big moment for transportation. Jonas also pointed to a pivotal November 6th shareholder vote that he says could help shift sentiment back in Tesla's favor. Next up, Zions Bancorp. Bank of America is upgrading the regional lender to neutral from underperform, saying credit fears are, quote, overdone. The firm notes the recent fraud-related loan write-down looks like a one-off event, not a systemic issue. With the stock trading about 20% below historical valuations, B of A sees room for a rebound and raised its price target to $62 a share. And finally, Moderna. UBS is cutting its price target to $40 from the prior $70 after the company's CMV vaccine failed a key late-stage trial. Moderna is ending that program, but analysts still see upside from its cancer pipeline and do expect the company to hit cash break-even by 2028 as it trims costs. UBS is still maintaining its buy rating despite the lower price target. The stock is down nearly 40% so far this year. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We're watching Supermicro, IBM, and Quantum stocks. First up, we got Supermicro, the major provider of servers, pre-reporting its first quarter earnings. The company expects revenue for the first fiscal quarter of roughly $5 billion. That's short of analyst estimates for about $6.5 billion. Some revenue that had been expected for the first quarter will now not be recognized until the following period, the company said. It also reiterated a revenue forecast of at least $33 billion for fiscal year 2026. The shares initially falling, then they recovered a bit. Now they're down 6%. Let's also talk about IBM. Those shares are moving lower after it disappointed with its revenue in two of its key software categories. Third quarter sales in the hybrid cloud unit that includes Red Hat increased 14%, but that is a slowdown from the previous period and below analyst estimates. IBM shares have climbed this year on investor enthusiasm for the software business, but the results suggest that organic software growth could be slowing. And Quantum stocks are in focus yet again. They're on the rise today after the Wall Street Journal reported that several of the companies are in talks to give the Commerce Department equity stakes in exchange for federal funding. This is a signal that the Trump administration is expanding its interventions in what it sees as critical segments of the economy. These stocks are very volatile, and today they're trading higher. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up next, we will be digging more into the phone wars and results from AT&T with the company's chief operating officer. AT&T swung to a profit in the third quarter, but adjusted earnings and revenues did fall short of expectations, due in part to a heavy promotional campaign in the fiercely competitive sector. Joining me now is Jeff McElfresh, AT&T Chief Operating Officer. Jeff, thanks for being here.
Hey, Julie, how you doing?
I'm doing well, thank you. And you guys did see an increase in your wireless subscribers because of those promotions that you were running. But I'm just curious, as you look at the sort of price competitive landscape right now, how long do you expect these sort of price wars to last? Is it just the new normal now?
Well, I think this industry has been always competitive and comes from somebody who's been in it for 30 years now, since the very beginning of the wireless industry. And we fare really well in the competitive marketplace. We've got a track record of doing that. I think what's important, Julie, is in the third quarter, yet again, is another proof point that AT&T's investment-led strategy to build America's most advanced communications network is paying off. I mean, we recorded 550,000 broadband net additions on our fiber and our fixed wireless network, setting the best ever in 8 years of broadband net add growth. And to your point, we did add over 400,000 high-quality postpaid subscribers. When it comes to price wars, I think what's really important and what we're here to talk about today is we're launching a new campaign based on feedback that we've received from customers all across the nation, that the truth's got to come out. The price wars and the misperceptions and all of the distractions, and in some cases, a lot of deception in that of our competitor T-Mobile in their quote-unquote price locks, which have historically had a lot of loopholes in it that they take advantage of. And so our campaign that we launched today is on behalf of all consumers trying to set their record straight about who's got the right level of network performance that customers deserve at the right price, that provides the right value and is backed up by a level of service that they deserve.
Jeff, this is a new tactic for you guys, talking about your competitors a little bit more directly by name. Historically, it was T-Mobile that was kind of sassy in that department.
Yeah.
What led to this sort of change in strategy in terms of sort of calling them out by name and talking about that?
Well, I mean, AT&T, we've been around for 150 years, and we have a way of doing things. We believe in transparency. We believe in providing a high degree of reliability for services that all Americans really do depend on. This is really important work for us. We take this job very seriously. It's why we invest more than any other player in the market to build the nation's best networks. And in fact, when we see claims coming directly from a competitor like T-Mobile with advertising that says they've got more towers, leading people to believe that they may have the absolute largest and best network, the opposite couldn't be truer. In fact, T-Mobile's got the smallest network, over 300,000 square miles smaller than that of AT&T. We own and operate the largest and most reliable wireless network. And when you're working in an industry for as long as we are, and you're seeing a competitor who repeatedly is getting corrected by the Better Business Bureau's advertising watchdog 16 times across 4 years, that's one correction per quarter. Enough's enough. It's time for somebody to speak out on behalf of consumers.
Jeff, at the end of the day, though, when you look at why consumers are making the decision of who their providers are, doesn't price trump everything else, even reliability? Or how are you finding that they're weighing those factors?
Actually, price, value, network performance, reliability, trust, all these factors are elevated in a decision for a consumer to switch service providers. I mean, let's face it, customers pay hard-earned money to be connected to the internet, and there's no company that is more capable and better positioned than AT&T to do just that. As the nation's largest and most reliable wireless network and the nation's largest fiber network, covering over 31 million locations and growing to 60 million in the next 5 years, our value proposition of what we offer to customers is being resoundingly backed up by feedback we hear from them. In fact, all of the customers that have fired T-Mobile and have joined AT&T do so because of network performance and price value. So we feel passionate. We feel fired up, in fact, and me personally, I'm fired up because I build these networks, and I have for a long time, and I know what it takes to put in place a network that people depend on. Great example of that is the first responder network, the FirstNet network that we were chosen by the U.S. government to build on behalf of first responders. And when we see T-Mobile pumping T-Priority as a first responder network, when in fact the fine print says may not work in times of emergency, I mean, that's just dishonest. The uncarrier should be called the untruthful.
Well, strong words, Jeff. I want for our remaining time, I just quickly wanted to switch gears and ask you about something else, and that is the iPhone 17 and this cycle that we've been hearing sort of through the grapevine that demand looks good, but what can you tell us?
Yeah, I think demand was good. I think you saw positive results in our print yesterday and that today at T-Mobile's, but I wouldn't characterize it as a super cycle or anything out of pattern. I think customers depend on this product. Wireless is an important component to what we need in order to conduct our daily lives. It's not the only one, though. And in fact, when we think about the phone wars that you cited, we don't view it that way. In fact, we actually have a vision for convergence in this country. We lead in convergence. We know that customers simply want to be connected to the internet, whether that's through a mobile device, via Wi-Fi at home. And that's why we're investing more than anybody else in this industry to build this network to cover more Americans. We know that when we connect fiber to a home or a business, we win. We know that all wireless technology, no matter what generation it is, requires fiber to perform well. And that's why we have made the decision several years ago to invest heavily in the future of American infrastructure by investing so heavily in fiber. And to the point with your prior guest and the theme of the day around all of the AI and the workloads that everybody is aiming to go capitalize on and bring into the market, guess what that technology needs? That technology needs high-performing connectivity, and that's exactly what AT&T delivers.
Jeff, good to see you. Thanks for your time this morning.
Yeah, it's good to see you as well, Julie. Thank you.
Got much more markets action coming up. Stay tuned. You're watching Market Catalyst.
master the markets and, dare I say, become a better investor in the process, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom. We're also teaming with some of the biggest rising stars in the financial community for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Welcome to the Opening Bid Unfiltered podcast.
Welcome to Stocks in Translation. Welcome to Financial Freestyle.
Welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk.
Welcome to the big idea.
Welcome to Weird Money.
From Wall Street to Main Street to the C-suite, we're your daily lifeline. Because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
Scott, it's good to see you here. So, little room for error. So far, this earnings season, yes, we're kind of going sideways here, but by and large, it feels like things are coming in relatively strong with the banks first setting the tone. Netflix an outlier. I mean, how are you reading it, and what does that mean for where stocks can go from here?
Yeah, and good morning, Julie. Great to be on the show. Okay, so our concern going into the Q3 reporting period had little to do with the consensus expectations themselves. Going into Q3, consensus was for an 8% index level earnings gain. We've got no issue. We think that's fairly straightforward to kind of achieve, if not exceed. The degree to which we exceed, though, we expect to be a little bit less this quarter than we did with the Q2 results, okay? So underlying fundamental trajectory is in very good shape, Julie. Our issue simply has been to what degree has this expected earnings delivery already been priced into stocks?
And what are the early indications and the early reactions this earnings season telling you in terms of the answer to that question?
It's telling us that the fundamentals are in good shape as we expect. So think of the bank earnings so far. But then we also have to keep in mind that there are going to be other macro influences that come in and can influence the price action shorter term, whether it's this emerging concern regarding credit, whether it's the government shutdown, other read-throughs, underlying economic activity that will come in occasionally and influence things. But generally speaking, financials tend to be the first sector to give you a more significant number of companies reporting. The results there in general looking quite solid. Price action a little bit more muted because of this emerging credit concern. As we go forward from here, okay, we're going to see a broadening across other sectors. And again, the storyline is going to be one where expect fairly persistent earnings growth. We do think we'll see a little bit of negative edge come in terms of companies talking about the tariff setup, but we don't think it's anything that's going to turn into a structural headwind at this point.
And Scott, I'm reading between the lines here, but it doesn't sound like you're that concerned about these credit concerns either, that, they're sort of flare-ups, but not a fundamental risk.
You used the term idiosyncratic a little earlier, and that's the way we're looking at this. At this point, I think, yes, we're all looking over our shoulder at a couple of things. The bubble dynamics that we had with the tech bubble, and then the credit concerns we had with the global financial crisis. And so I think many eyes are looking at this, and when you see this instance come up, is it a canary in the coal mine, or is it the beginning of something bigger? Everything we can kind of assess at this point says, hey, look, it looks like it's mostly one-off. Of course, we have to be careful of one-offs accumulating. But I think at this point, what we got from the banks was pretty good conviction that underlying credit conditions are in pretty good shape.
And then, Scott, as you know, one of the other big debates out there is whether AI is in a bubble. This is something that you guys wrote about recently. And I've also seen lines like, okay, why are bubbles so bad? So I don't know, how are you guys thinking about it? And is this another potential risk for the market?
Yeah, I think it comes up in most conversations, Julie, and you can't get away from the discussion. And what happens when you have this magnitude of performance that we've had over the past 1 to probably 3 years now in terms of this underlying mega cap growth tech AI driver, it conjures up that bubble discussion. What we're focused on is that typically what brings bubbles to a burst, if you will, is an inflection to the negative in fundamentals, okay? So right now, our line of sight, certainly into 26 and probably into 27, and perhaps even longer, is a fairly persistent positive setup for underlying earnings growth drivers. As long as that continues, the bubble issue remains topical, but we don't think it translates into a significant market issue. Now, shorter term, which is a concern we've had going into the Q3 reporting period, expectations can get a little bit ahead of themselves, such that even if you get good fundamental delivery, it's already priced in, right? So the bottom line here in this bubble discussion, we think the AI playbook here, the infrastructure build, and then the eventual read-through into a more efficient corporate America is still early innings. So we want to allow for shorter-term volatility around that expectation setup, but under the surface, we don't think we're looking at a bubble circumstance at this point.
And Scott, I know your team has also written about applying what you call the GARP overlay on AI, right? Growth at a reasonable price, which I've been amusing myself by thinking of it as AARP, AI at a reasonable price. But how do you find, I mean, like, where do you find that at this point?
Julie, I'm much closer to the AARP connection than you are, but so let's be clear on that. Essentially what it comes down to is this notion of what's being implied in the stock price right now relative to where consensus is. And so when we look down our list of companies, this is where we go with this growth at a reasonable price. We find companies that are selling at PEG ratios that are fairly consistent with overall market averages. I'll give you an example. The Mag 7 in aggregate right now is at a PEG ratio, so this is PE to growth of about 2 times. That's about the same as for the other 493. So what's happening here is the market is fairly efficiently pricing in current growth expectations. Now, there are going to be certain companies that don't have an underlying earnings component. They're still very early in their life cycle. Those are a little bit different. But the tried and true companies that are generating positive earnings, positive free cash, that are contributing to this AI infrastructure build, generally speaking, are still in pretty decent shape in terms of, again, underlying growth, justifying where the valuations are at this point.
I mean, Scott, it's interesting that you use the Mag 7 as an example because, of course, in that cohort, there's a pretty big range of those valuations and how close they are to the average valuation ratio. But is that something that you would be advising individual investors to also look at, sort of look at things that are not outliers in terms of their valuation?
So, where we go with this, I'm sort of a free cash flow junkie, if you will. I pay a lot of attention to free cash flow trends and growth drivers, okay? When you look at this Mag 7 component, now there's a couple that are probably outliers that we have to handle differently. Tesla would be an example of that. But in aggregate, when you look at these companies, the free cash flow generation coming out is astounding and something I haven't seen in my 40 plus years of doing this. This is much different than the tech bubble, okay? So what I have is a set of companies with different phases in the way they're playing through this AI opportunity that are spending a lot on CapEx, got that, but still generating positive free cash flow, and in most cases, still reducing fully diluted share count. This is a very healthy setup, right? So these companies are spending, but not in a way that is in excess of what they're generating in free cash. They're not having to leverage up that much, and they're not having to issue that much stock to do that, which again, big difference from back in the 99, 2000 timeframe. So all told, when we look at this, the financial health of these companies is very, very compelling. And so they're in a good shape to continue to spend and have it be persistent so long as those underlying free cash flow trends persist. Big focus for us, and it kind of permeates the way we're thinking about large cap U.S. equities more broadly right now.
Scott, great to see you. Thank you very much.
Thanks, Julie.
to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom. We're also teaming with some of the biggest rising stars in the financial community for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Welcome to the Opening Bid Unfiltered podcast.
Welcome to Stocks in Translation. Welcome to Financial Freestyle.
Welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk.
Welcome to The Big Idea.
Welcome to Weird Money.
From Wall Street to Main Street to the C-suite, we're your daily lifeline. Because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
Software companies are turning to agentic AI in their bid to compete with OpenAI. Workday saying it plans to win that AI agent race. And joining me now on this, Workday CEO Carl Eschenbach and Yahoo Finance Executive Editor Brian Sazzi with me as well. Carl, it's great to see you.
Good morning, Julie. Good morning, Brian. Great to be back with you.
So I'm always curious at exactly how this stuff works. So this new product you guys have, let's say I have a contract I need to review. How exactly does it work? What does it do for me?
Well, a lot of contracts out there that people have in the enterprise are what we call unstructured data, and they're hard to bring in. Someone actually has to physically review them. We can use AI to ingest that contract into our library or our database, and then we can review it. We also have now a contract negotiation agent. So think about how much time, effort, and energy a lawyer puts into redlining a contract to go back and forth. Because now you have this library with all of your contracts, you know the terms you want to have in a given contract. So now you can compare a new contract to the terms you want, redline it automatically, and then push it back to the party you're negotiating with. And that's all automated. And you take all that mundane work of lawyers reading their contracts, redlining them, and doing that back and forth. You automate that. So the productivity you gain for your attorneys is incredible, and it reduces your cost to serve the business as a whole. That's just one example of many different AI agents we're bringing to market.
In the past month, you've been very aggressive with rolling out new AI products, announcements. How are they being monetized?
Yeah, so it's been monetized multiple ways. In fact, at our Rising User Conference, which I was talking to you about earlier, Brian, that we had in San Francisco, where we celebrated our 20th birthday, we had over 30,000 live people in attendance. We rolled out a new pricing model for AI agents. We call it Flex Credits. So a company or a customer can buy a pool of credits, which gives them 100% access to all of our agents. Our agents are built into the platform, so all of our customers are entitled to all of our agents. And because now they don't have to buy each agent or buy a capacity of each agent, they buy credits, and those credits can be used for any of our agents. And as they use our agents and they see more value and there's more usage, they burn down those credits. So it's almost like a prepay, if you will, for a capacity, and then you burn them down through the usage of our AI agents, as well as our API access to the platform. It's a powerful new licensing model. It takes us away from purely seat-based licensing, and it's something our customers have showed really strong receptivity to.
Is it moving the earnings needle for a Workday?
I think over time it will have a really nice impact on our business. I think there's a narrative out there today, Brian, that if you're a seat-based licensing company, that AI is going to be very disruptive to you. I think that narrative is false, if I'm honest. I think it's overblown. I think people like us are uniquely positioned, and AI is a tailwind for us, not a headwind, for many different reasons. And this new licensing model will allow us to monetize our agents more aggressively in the future. I will say, though, today, we are already seeing significant adoption of our AI agents. 75% of our 11,000 customers today are already using AI from Workday, and 70% of our new sales include AI or AI agents into our customers. So we're already monetizing it. This is just new pricing and packaging. It's a business model transformation, and it takes us away from being purely based on seats to a new model for AI.
Now, going back to the example of the new contract tool, if I have ChatGPT, couldn't I just upload all my contracts there and ask it to do the same thing? In other words, what's that added value proposition?
Yeah, well, Workday, we are a system of record. We have one of the most highly curated, cleanest set of data in the world for HR and finance. And your AI is only as good as the output, right, or the input, I should say, of the data you're training off of. And our data is completely clean. We have 75 million users on our platform today, Julie. 75 million users. We're transacting 1 trillion transactions a year. That gives us an unfair advantage to bring true value to our customers. Now, we have a system of record, if you will, for HR and finance, and now we have it for all your contracts. And it's built into the fabric of Workday. It's integrated. It's not bolted on. OpenAI and all these others have really impressive solutions, but they're not a system of record. We don't hallucinate because of the cleanliness and how highly curated our data sets are. And now we're bringing that in for document management across your entire enterprise with something like Eversort and what we announced earlier today.
Now, Carl, I know part of the selling point, not just from you guys, but for the promise of Gen AI generally, is an increase in productivity. And I know that you all decreased your headcount earlier this year. How much of that is then being made up for by using some of these AI tools?
Well, I think there's two different questions in there. Number one, we did do a restructuring earlier this year. But we also talked about that restructuring was to give us more operating leverage to invest back in AI. And we also are now starting to look at a global workforce, trying to move our workforce closer to our customers around the world. So that's really what we've done. In fact, we're hiring as many people back as what we did in a restructuring. So I think there's a narrative out there that we did it purely because of AI. No, we did it to leverage AI and invest more into the platform as much as anything. Today, I think a lot of people, quite frankly, who are doing restructurings lean into it and say they're doing it purely because of AI. I don't think that's always true. I think people have overhired over the last 5 years coming out of COVID. They're restructuring to drive operating leverage in the business. That being said, everybody, including us, across every single function in the enterprise at Workday, we are leveraging AI. We're getting operating leverage, and we're using those operating leverage in those cost savings to invest in the business to drive growth for the company, also for our employees. We don't believe AI is going to replace humans. We think it's going to drive a step function change in human productivity, and we're going to amplify human performance, not replace it. So I think, and definitely me, Julie, I have a different view that we're going to, take out 20, 30, 40, 50% of our employees because of AI. I just don't see it. We're going to actually amplify human potential, not replace it through the use of AI.
Maybe I can channel your VC background a bit here. Some of the valuations we are seeing on private companies tied to AI, even in OpenAI, I mean, they're not making any money, but they're signing big deals. Do things feel frothy to you?
Listen, I'm not in the venture business. I'm still a partner at Sequoia and help them when I can. But I do think, valuations are frothy. I do think over time that's not uncommon when you have these, big tectonic shifts and there's a massive amount of private capital going into these businesses. But I think that will kind of play out over time, and I think it will be a rich opportunity for folks like Workday to look at some of these companies when they decide to go raise another round. Maybe their valuation expectation isn't going to come to fruition, which gives us a great opportunity to come in and potentially acquire these companies and bring them onto the Workday platform. Recently, we acquired a company. We announced it at our Rising User Conference, Sana, which is a powerful AI platform that we acquired. And prior to us acquiring it, we were also investors to our Workday Ventures business. So we're investing in these businesses ourselves. But I do think, listen, valuations are a bit frothy, there's no doubt. But that's not uncommon in some of these kind of big tectonic shifts.
But you're not willing to overpay. You're not willing to overpay. You still have.
We will not overpay. I think we're very curious in looking, and we're open to acquisitions. We've made 5 AI acquisitions, Brian, in the last just under 2 years, and 3 of them have been in the last, if you will, 3 months. And I think we look for companies that have great value, bring us great technology, bring us great founders and people, and they fit adjacently into our go-to-market strategy so we can amplify their growth as they become part of us.
early bird catches the gains. This is Morning Brief Market Sunrise. Live from London, we deliver an early read on global markets, from overnight action in Asia to real-time sentiment across Europe's major trading desks and a live look at US futures. We cover the stories to help you, the individual investor, get the edge with actionable financial information and unbeatable context. So grab that coffee, tap in, and let's own the morning.
It's 11 o'clock.
It's time for Yahoo Finance's Market Minute. U.S. stocks pushing higher as investors digest a slew of corporate earnings. On the commodities front, oil is jumping as President Trump ramps up pressure on Russia. The U.S. has blacklisted Russian oil giants in an effort to cut off revenue that Russia needs for its war effort in Ukraine. Plus, watching quantum stocks as Yahoo Finance reports the U.S. is not necessarily planning to invest in those companies. The Wall Street Journal had previously reported that the U.S. was weighing stakes in those firms. And Rivian is planning to lay off over 600 workers as customer demand for EVs softens. That's according to a Wall Street Journal report. The EV maker cut 15,000 employees at the end of last year and had a smaller round of layoffs affecting 1.5% of its workforce just about a month ago. And that's your Yahoo Finance Market Minute. You can scan the QR code below to track the best and worst performing stocks of the trading session. Into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets now. Taking a look at the major averages, we are seeing a rally take hold, although it's a modest one when it comes to the Dow, which is up just about 41 points. We have earnings kind of doing the push and pull thing today. The S&P 500 up about 0.4%, and the Nasdaq, despite the declines in Tesla, is up 0.6%. Another cohort of stocks that's rising today, quantum computing ones. They're rising on a Wall Street Journal report that several companies are in talks to give the Commerce Department equity stakes in exchange for federal funding. Joining me now at the desk to explain why the U.S. might want a piece of the quantum business is Yahoo Finance tech editor Dan Howley. And it's really interesting. I talked to Alan Baratz, who is the CEO of D-Wave, one of these quantum computing companies, just last week. And he said China is ahead of the U.S. when it comes to quantum. And he was calling for, if not this kind of investment, this kind of, interest and a push behind it in the U.S.
Yeah, I mean, we have seen an increase in quantum investing from the likes of Microsoft, Amazon, Google. IBM has been in the quantum space for, it feels like forever. So you can't count them out when it comes to this idea of quantum. But yeah, I mean, this is kind of... It's not necessarily the future of all computing. It is a future of computing. I think the thing that people might get wrong when it comes to quantum computing is that they're going to be, the new CPU, your central processing unit, your regular computer, your smartphone. The way that some experts I've spoken to have phrased that is like taking an F1 car to the supermarket. Like it's impractical. It's unnecessary. These computers are also massive. When you look at them, they don't look like your standard laptop.
Right.
These are in a facility. They have to be shielded from the outside world. Things like hydrogen molecules from the air can mess up the calculations that they're doing. They're dealing with subatomic particles that are called qubits. So when you look at a regular CPU, it talks to the different parts of the computer using ones and zeros. It's called binary. It's the base computer language. And then everything else kind of builds on that. So when you swipe, eventually that's translated into a 1 or a 0, and it's giving the processor instructions, or and vice versa. These qubits exist as ones and zeros at the same time. So what that allows is for them to do parallel processing. And essentially, that means that you would be able to do calculations that would have taken classical computers potentially tens of thousands of years to complete. So it's a powerful technology. And, the folks that I've spoken to in the past have said it can influence everything from healthcare to sciences of materials, coming up with, new types of structures, things along like big questions, right? We're just not there yet. And so it's a matter of researching it. And there are folks who will say, well, it's right around the corner. It's been right around the corner since like the 50s. And so there's constant advancement in it for sure, but it's not to the point where it's like, all right, well, tomorrow I'm going to be able to walk down the hall, flip a switch, and turn on a quantum computer. But it is very important to get into because, on the world stage, if you don't want to cede the lead in any kind of technology,
right,
you need to make these kinds of investments.
Well, I'm sure we're going to keep talking about it. So, Dan, thank you very much for giving us a little bit of a primer there. It's hard to wrap your head around. Thank you so much. Appreciate it. Well, the largest alternative investment manager, Blackstone, reported strong third-quarter distributable earnings. They rose to the tune of 48%, though we are seeing the shares down by about 5% today. But let's talk through the numbers with Jonathan Gray, Blackstone President and COO. John, thanks for being here.
Great to be with you, Julie.
So let's talk about those distributable earnings, which, as I mentioned, were up 48%. Does this feel like you've hit a turning point, we're past a turning point, and things are just going to improve on that front from here? Or is it going to be sort of lumpy going forward?
Well, I would say there are a number of really positive things that are happening. One is we've made some great decisions on where we invest capital. We focus pretty deeply in digital and energy infrastructure, and that is paying off for our customers. It's leading to more inflows, $54 billion in the quarter. That's the fourth quarter in a row we've had more than $50 billion. And that leads to these strong earnings. But as we look forward to your question, we've got a number of things that make us feel good. One is we've got this cyclical upturn in deal activity. As rates have come down, spreads have come down, as the IPO market has reopened, the deal dam is breaking, and that's very helpful for our business, and that should provide support to earnings going forward. And then we have these big secular tailwinds. We've got areas like insurance and wealth. We've got geographic areas like India, areas like life sciences. All of this gives us a lot of momentum as we look at our business going forward. So I would say, yes, we've got a bunch of confidence as we look into 26 and beyond.
And we're going to dig into some of those areas in a moment. I want to linger on this stock action for just a moment. And I know you're focused on the long term, not just the one-day action. But I have been trying to dig into where the disappointment might lie, because on the face of it, the numbers look strong. And one analyst pointed out to me that management fees might have been a source of disappointment here, and that there was perhaps some confusion around the guide on management fees. Can you give us a little bit more color on that?
Yeah, I think, it's really hard to focus on markets and sentiment. And I would say in general in markets, right now there's a lot of skittishness. There's a lot of concern around what's happening in private credit, which we think is much sounder than some of the headlines. And so you're at a time in the world where people are glass half empty, and you get these sort of sell-offs. On the management fees specifically, I think we were up double digits in the quarter. Our AUM was up 12%. We see a lot of momentum in our business across all three of our channels here, managing capital for insurance companies, for individual investors, and institutions. So I think it's really hard to react day to day. I would tell you, most times I think the stock's going to be up. It tends to go down, and it's inverse. And so reacting day to day is hard. What I can say is over the last 5 years, the stock has delivered a 3.5 multiple in total return for our investors. And when we look forward, given the strength in the underlying business, we feel quite good.
Fair enough, Sean. You mentioned credit and some of the skittishness. You guys, your credit assets are above $500 billion for the first time, at $508 billion. There has been concern about risk in the market, but I want to ask about something slightly different, which is more valuations in that private credit market. And I'm curious if you think valuations there and returns there have perhaps peaked, given that, we're seeing rates go lower and other factors.
Well, I think on valuations in private credit, it's different than equity. As long as a credit is performing, you're generally carrying it at or around par for that loan, because these tend to be floating rate loans. So it's really only a valuation issue if you have significant credit issues. That's not something we're seeing broadly in our portfolio, or frankly at the market at large. I think the second part of your question is what happens as rates decline. And yes, there is a reality when you have floating rate products that your dividend yield is highly correlated to where the Fed sets rates. But I think what's really important to keep in mind is the premium that private credit can give versus what you see in the liquid market. So because of the farm to table model we have, basically taking investors' capital and bringing it right up to borrowers, you avoid a bunch of those securitization, origination costs, and in that process, you drive higher returns. And interestingly, as you bring down rates, the relative premium on a percentage basis from private credit actually goes up. So I think you're right on the absolute return concept, but on a relative return, that's where we see an enduring premium for investors of ours in private credit.
Okay, fair enough. We'll obviously continue to focus on that private credit market. You guys are huge in data centers and the AI investment. And I know you've talked a lot about this area recently. As you know, there's also a lot of debate about whether there is a bubble there. So the valuations conversation is definitely relevant when it comes to data centers. Are you applying a sort of different lens to those investments than you have been? Are you scrutinizing them a little more closely?
No, I think we've been pretty disciplined the whole time. When we look at these, either on the equity side as an owner or when we finance them, we're thinking about the same things. And the keys are we signing a long-term lease with a very large investment-grade company? And that really provides the ballast and safety. So if one of the largest companies in the world with a $1 trillion to $4 trillion market cap, strong investment grade rating, signs a 15 to 20-year lease, you have something of incredible value in addition to the hard asset you built that's got access to very valuable power. So that to us seems like a sound way to do this. We continue to be disciplined. We're not, these are not condos in Miami where you build them speculatively. These are long-term leased, pretty conservative assets in that sense. And so we like this business because it provides the foundation for what's happening in the AI revolution. AI is going to bring a ton of productivity to businesses, to all our lives, but it needs this foundation. It needs chips. It needs data centers. It needs power. We've leaned in really hard in data centers, also really hard into energy. And we think that's a really sound way, the picks and shovels here, to support this major technological change.
John, you made some comments recently about AI that I thought were really interesting, where you talked about there's so much focus on valuations and less focus on where AI could be disruptive to existing industries. And on that front, there was a report that OpenAI has hired some ex-investment bankers in order to train its models to build financial models. And so I wonder what your thoughts are on your business itself, on the financial business being disrupted by AI.
Yeah. It's a great question. I would say that discussion around disruption is so important because everyone's over here looking at bubbles. They're not looking over their shoulder as industries change. And I would say at our firm, I think when you think about the investing function, these tools will be super helpful. And they're already helping us summarize data, come up with thoughtful questions. I don't think they're going to displace our analysts and associates anytime soon, but they'll be very helpful. There are a lot of functions here, though, where we're seeing real productivity gains. If you think about Claude Code and our engineering folks here doing software work, that's very helpful to make them much more efficient and productive. Our video and content team using these AI tools, also helpful. In the legal area, in places like marketing compliance, we're able to use these technologies to, again, make our people much more productive in what they're doing. So I think we're going to see across the economy, including here at Blackstone, a bunch of changes. Some of it will take time, but I think there'll still be plenty of jobs. It's just going to be this really enhanced productivity in a number of areas.
John, finally, I want to ask you about probably my favorite comment on the call, which was somebody asked you or asked the executives how you're sort of approaching the retail channel, how you're branding Blackstone, and were you going to have a Blackstone Stadium anytime soon? Which you guys said, no, we're probably not going to have a Blackstone Stadium. But I do wonder how you are approaching that branding question, especially as you drive more and more into that retail channel.
Well, this is a hugely important area. Christine Anderson, who runs our corporate affairs, oversees our marketing. We spend a lot of time talking, as also with Steve Schwarzman, about how we can position this firm, how the world can see us. And we are moving, as we have really now over 20 plus years in the wealth space. We're broadening who our customers are. And reaching them is obviously different than when you have individual institutional meetings. And so it's critically important that we partner with the large financial institutions and distributors and wealth managers at the home office. Really important. We build relationships and partnerships with financial advisors here in the U.S. and around the world, and then ultimately with underlying customers. But this is still a pretty targeted sale. It's not for every consumer out there. So I think you'll see us show up in a relatively small number of places where we think there are a large number of potential customers. I think this is an important part of our business, and our brand matters. The good news is we understand at the end of the day, it's all about performance. We've got to deliver for these customers. We've got to deliver for financial advisors. And then it's about growing awareness and doing it in the right way. So you will see a little more of Blackstone out there. I don't think it's a stadium anytime soon.
Okay. All right. Well, we'll keep asking you about it. Maybe things will change. John, thanks so much. Good to see you.
Thank you so much. Be well.
Take care. You too. Much more markets action coming up. Stay tuned. You're watching Market Catalysts.
first thing, of course, is AI. It's no surprise that high quality data continuously collected is what's required to make really accurate predictions and inferences about your health. And that's an area of investment that we've been investing in for several years, but I think we really want to take it to the next level. The second thing, of course, is international. Today, we're largely a business focused in the United States. But we want to take our business on the road and expand around the globe, and we expect to see that drive growth for the next several years. And then the final thing, of course, is we are mission driven, and our mission is to make health a daily practice. What we expect to be able to do is to start to work our way into the healthcare industry. Today, we work with insurers. In the future, we expect to work with insurers and providers and clinicians, and expanding our product platform and technology platform to work in hand with traditional healthcare is a big part of our investment going forward.
So, Tom, put some of that together for me, in particular the AI and the healthcare piece, because ideally, one would see a future where you could use a tool like an Oura Ring or whatever tracker you're talking about to be predictive, right? To say you're at risk for a heart attack or what have you. Here's the signs. Here's what you need to do. How far away are we, or are we already there, in terms of that kind of functionality?
So today, for example, Oura can look at your biometrics and make a prediction about your health status in a couple of days. The feature is called Symptom Radar. It looks at several biometrics, looks at what's normal for you, looks at the trends in your health, and can say something like, hey, you're showing major or minor symptoms that are expected for you in the next couple of days. And that's a very short time horizon prediction. This has been incredibly useful for lots of people. I used it personally to help stay healthy when I'm traveling. I'll take a day and rest and break so that I can recover without getting sick. But it's really surprising and powerful how accurate it can be. You think you don't feel any symptoms at all, and then 3 days later you're on the couch watching Netflix surrounded by Kleenex. This kind of prediction, that's a short-term prediction. But the density of data and the quality of data that we can collect, including data from the ring, but also data from outside, things like I'm wearing a glucose monitor right now, or we recently introduced blood biomarkers where you can actually sign up and get those tests taken, and then we'll bring them together inside of your Oura experience. Adding all that data together lets us make longer-term predictions. And I think the way to think about this is that it's almost like a doctor in your pocket. You've already got a supercomputer in your phone. You've got a device on your body that's measuring, kind of clinical grade data on a constant basis and looking at you overnight, which means your body's at rest. So we get a very good signal, and then feeding that information to a machine intelligence, which is looking over you. And it's not just the doctor, in your pocket that's sort of saying, hey, something's going to happen to you, you got to watch out for. It's also trying to steer your behavior in kind of that preventative medicine way, where it's trying to influence your behavior to help you live a longer and healthier life. AI is the foundation of all of that. And if you think about medicine today as being practiced on the averages, and you go to the doctor once a year, the difference is that this AI will be personalized to you. It'll be custom to you. It will know your data, your context, your genotype, your phenotype. In the future, that's the future of medicine. And it's not only personalized to you, but it's also predictive and can work with your clinician to help them understand what's going on with you, like a co-pilot for your doctor.
Tom, I have so many questions for you. I'm curious what you make of the sort of criticism of this type of hypervigilance and transparency of the data, that it actually increases anxiety, can increase, sort of overdiagnosis or misdiagnosis in some cases, because you're people can obsess over having all of this information.
Philosophically, I think our approach is that we want to recede into the background. We don't want to be reminding you every day of your mortality and to create some anxiety. We try and make the experience be as low impact as possible. I think that's actually partially because we don't have a screen on the device. It just sort of is there monitoring you like a guardian angel in the background. But when you need it or want it, it's available to you, and you can investigate it at your leisure. Now, that being said, there certainly are people who I think become overly obsessed. I don't know if your husband talking to you every morning about his sleep score qualifies, but the point is that the information is power. And that power, you can use it to live a healthier, longer life. And I think that's incredibly important. The idea is to give you agency in your health journey. And I think this is a trend that's been going on, for decades as people have learned more and more and gained more access to health information. Scientific papers are available on the internet. Everyone can become an expert. Now, that being said, we don't want you to be obsessed. If you are obsessed, please, take the ring off. Give yourself a break, because one of our core values is that you should live a life of balance. And balance means, finding the right, set of circumstances for you in your life where you are. We want to meet you where you are right now and give you the power to drive your own health journey and not be just a passenger on the bus.
Some breaking news crossing the wire. President Trump has pardoned Changpeng Zhao, the convicted founder of the crypto exchange Binance. The Wall Street Journal reported the president pardoned CZ, as he's known, on Wednesday. This comes following months of efforts by CZ to boost the Trump family's own crypto company. Trump recently indicated to advisors that he was sympathetic to arguments of political persecution related to CZ and others. That's according to the Journal. White House Press Secretary Caroline Leavitt said that Trump had, quote, exercised his constitutional authority by issuing a pardon for Mr. Zhao, who was prosecuted by the Biden administration in their war on cryptocurrency. A pardon will likely pave the way for Binance, the world's largest crypto exchange, to return to the U.S. That's after the company pleaded guilty in 2023 to violating U.S. anti-money laundering requirements and was barred from operating here. Binance did not immediately respond to the Journal in a request for comment. We do know, of course, very broadly that this administration has been a much, much friendlier one to the cryptocurrency industry.
Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blickery, your host, and with me is Yahoo Finance's Ali Canal, who's here to keep the discussion simple, accessible, and also lively. Today, we're going to be talking about the cooling labor market, if the Fed is once again too slow to cut rates, and how to square that with a stock market that keeps hitting record highs. Our phrase of the day is the September effect. History says we're in the worst month of the year right now, and the weakness tends to come in the back half of the month. So how much do investors really need to care about history rhyming? And this episode is brought to you by the number 9.7. That's how many percentage points of pure profit you would have missed out on had you panic sold after Liberation Day and missed the single best day of the year. How to make an investing plan that keeps you cool and calm when the headlines, they get scary. And today we're welcoming back Phil Rosen, co-founder of the Opening Bell Daily. He recently left Business Insider to build his independent, data-driven markets outlet, along with Anthony Pompliano, and he's also a published author twice over, penning a collection of New York-centric vignettes in Life Between Moments, as well as a travel novel, Everywhere But Home. So, Phil, it is great to see you here, and we're going to get to our phrase of the day, September effect, in a minute. Just tell us how you're seeing the markets right now overall.
So first of all, thank you both for having me. It's great to be back. The market right now, we have a lot of positive momentum, and I think that is the twist in history right now. So typically we're going into September very weak and very jittery, and investors across the board are expecting this pullback. But I do think this year, famous last words, this time is different. However, the rate cut on September 17th, which is pretty much guaranteed at this point, I think that is going to see markets finish higher in September, which is very unusual because I think in the last 10 years, September's finished down 2% on average. And if you go back to 1950, it's down like 0.8% or something like that.
Yeah, and so that's perfect. Let's get into our phrase of the day. That would be the September effect. And this is the historical tendency for stocks to post returns that are weaker in September than the other months. And it's important to note that this is just a pattern based on history, which may or may not pan out. But I'm wondering how you think about seasonality in general. Seasonality just being, the same types of things, patterns that we see in the market happen year after year. How much do they play into your analysis?
So I think a lot of this, especially in September, is a self-fulfilling prophecy, right? Investors are expecting this September effect to take hold. But again, I don't know if it applies as much this year because this has also been one of the wildest, most eventful years in market history. And, we all know this as reporters. We're writing about it every day. But we have the Federal Reserve has been pushing back and forth with the White House. We have these tariffs, and we have this now widely expected rate cut in a week. So all this, I think anything is up for grabs right now, but I don't think seasonality will have as much of a play as history suggests.
You can even look at sell in May, go away. That seasonality trend did not work out.
Well, I've done some studies on this. Sell in May and go away. It's more like hedge in May and go away. It's evolved over the years, but we've seen different patterns from like 1940s to 1980s versus 1980s to now. You've said some interesting things here, and you mentioned the fact that this is a wild year, Phil. And I was looking at seasonality coming into the Trump presidency, and you can do seasonality. You can slice it and dice it several different ways. And one of the ways is to look at what year of the presidential cycle we're in. This is the first year. This is Donald, even though it's his second term, it's his first year of this term. And I got to tell you, what happened around Liberation Day completely destroyed the seasonality chart. And then the market kind of came back, and it seemed like at the end of August, we were right on track again, according to some models. But in general, just talk to us about, especially maybe as in terms of how you cover these markets, what you've seen and how this has surprised you this year, some of the wild cards.
So I think right now the S&P 500 is actually having a better than average year generally, but also a better than average post-election year. So all this is going against let's say the tariff doomers in the start of the year. Everyone thought tariffs would destroy the market. They thought the Fed independence battle, that would also destroy the market. But pretty much investors have not even paid attention to this, let's say when you zoom out. So I think a lot of the bearishness has been sort of eked out of the market right now, and almost every single firm has turned bullish for the year. And the narrative of betting against the Bears, I think that is the story of the year, because the Bears have been the loudest, certainly in the first half of the year, but all the bulls have been the ones that ended up right.
But it is interesting to me as a reporter, like you were saying, covering this day in and day out. There are a lot of bulls out there, but there also are more cautious voices. Even when we talk about rate cuts, Eddie Ardeni from Ardeni Research, he's fan of the show, friend of the show, and he said that maybe the Fed shouldn't be cutting right now, and that could actually maybe lead to a market melt up, and there could be a lot of money running in here at a time when you have inflation that's still hot. There's also this debate about whether or not we're not too heavy, too concentrated in the market. So it does feel like at the same time, there are a lot of unknowns, and there is this tension among strategists about what comes next.
So I think Ardeni is definitely not alone in that view, right? And I read his research all the time. He's super smart. I will say our team at Opening Bell Daily, we've pretty much been calling for a rate cut since about March. So we do think the Fed has been slow to respond in policy. And I think the jobs report really confirmed that.
Yeah, that was dismal in a lot of ways. And then we learned retroactively that one of the months, a few months ago, I think it was June, turned negative, and that's always had it been negative in June, we probably would have had a rate cut already. And so that kind of brings to the forefront the issue: is Jerome Powell and the Fed a little bit too late? What do you think about that?
I do think they are too late, but I don't think it's necessarily Jerome Powell's fault. I think it's a structural deficiency of the Fed, because it's a backward-looking institution, right? But markets move so rapidly, the economy can change faster than we think. But the Fed is pretty much working with a backward-looking mandate, right? And then also the data can be hit or miss on whether you believe it or not. Maybe not, believe is not the right word, but it's always revised, right? So the Fed's working with a pretty difficult circumstance. So I don't know if it's necessarily Jerome Powell. I think if anyone was in that job, they would probably be late this year.
Yeah, I don't envy anybody in that slot. You just brought up the data, and I'm wondering what you've thought about all the controversy surrounding the BLS. And a lot of this comes from the fact that since the pandemic, people just haven't been responding to these government surveys, and so you can't rely on the data as much. The margin of error is greater, and so I think it's no surprise that we have June being revised negative. There's a huge leeway that you got to give this data. So what do you think about the issue that Trump has raised the question of integrity? Do you think that's an issue?
So I don't know if replacing the head of the BLS is going to change the integrity of the data. I think the data was pretty, let's say, it was going to be revised no matter who is in charge, right? So I don't know if Trump putting his own person in there is going to improve or worsen the data, because I think it's, again, these are very old, methods that they're using to track all this data. And I, for one, I try to look at alternative sources of data, try to accrue a bunch of different sources when I make my analysis on the market. And I would never just rely on, let's say, the BLS to determine what I think is going to happen next in the market.
So what are those sources of data for you that really inform your viewpoints when it comes to
what do you look at every morning?
Economy?
Yeah.
So I think anecdotally, I talk to a lot of people. So I talk to a lot of strategists, as you both do. I talk to a lot of economists, and I talk to people in hiring manager positions, right? Are they hiring? Are they not hiring? I actually met this engineer the other day, and he told me that, so he's been at this firm for about a decade. This is a big tech company, and he used to do 2 interviews a week. This was about a year and a half ago, and now he does about an interview per quarter. And to me, that was like a very red flag, let's say, on the labor market.
I want to talk about some of the market stuff that we're seeing. Concentration has been a big issue. Is too much of the market's gain due to just a few companies? And arguably, it's been that case over the last few years. And the other thing is, we're in the 3rd year of this bull market now, and that's typically, you don't see the gains that you saw in the first 2 years. I would say 23 and 24, we had gains of 20+%. In the S&P 500, now we're looking, I think we're on track for 9 or 10, which is not bad, especially for a 3rd year. But how do you see the concentration issue evolving?
So I do think that's a very relevant issue to talk about, right? It's super concentrated. We're at .com levels. And that's certainly not a comparison you want to hear in any context. You never want to be compared to the dot-com bubble. But I think the difference today is that the companies that are at the top of this concentration, the Mag 7, right? We've never seen companies this profitable with this large balance sheets. And that, to me, that does give some cushion to that concentration argument, right?
That the earnings have justified it, maybe.
Yes, I think earnings have definitely justified it. And I don't know if that's going to last for much longer. But up to this point, I don't think it's, let's say, something we should be overly concerned about. And again, I think I've seen S&P 493 earnings are slowly going to catch up in the coming quarters while Mag 7 slows down. So that is something I think worth monitoring as well.
Yeah, and Torsten Slok from Apollo, our parent company, he did publish quite a bit of research about how concentrated we are in this market. And that's because of those hyperscalers and the data demand and how much CapEx they're spending. Given that we just wrapped up this latest earnings season, were there any little signs that maybe that demand is starting to weaken just a little bit? I know NVIDIA missed on data center revenue. Was that concerning to you at all?
So I'm not sure if I have much to say on the demand side of that data-wise, but I do know we've never seen this many S&P 500 earnings calls mention AI, right? So that's, on one hand, you could say, oh, this is a top signal. Who knows? And then we also have data center spend that's going to keep increasing for probably several more quarters. So all these things, it's like...
And the Bitcoin mining companies transitioning their businesses.
Of course.
Yep.
So you could argue very convincingly that there's a lot of froth in the market right now with AI, with crypto, with some of these meme stocks. But also you could take the other side and say earnings have been phenomenal and they're projected to be phenomenal again in the fourth quarter.
That's why I think this market's been a little confusing, because you can argue both sides of that equation. And we talk about retail traders, unprofitable tech that's been leading the meme stocks, like you mentioned. They're sort of leading this market higher and dragging the institutions along with it. So that's been something that
I see that too, Allie. Hold that thought, though, because guess what? We got to take a short break. Coming up, we're going to break down the number that captures market regret and a runway battle between David and Goliath, but with stocks, of course.
Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
This episode is brought to you by the number 9.7 percentage points. That's how much profit you would have missed out on had you sold at the lows after that scary post-Liberation Day sell-off and missed the April 9th rally. So one day, nearly 10%. And Phil, I'm saying this because it kind of opens up a discussion in a market psychology and about staying invested, all these things that we like to talk about. How do you think about this phenomenon, and how do you tune out the noise? We're all in the media here, by the way.
That's a very difficult and timeless question. I think if you are someone with a 30-year investing horizon, you can pretty much ignore the news, right? And I say that as someone who's in the news.
And who probably has a 30-year investment horizon.
Yes, exactly. So for myself, I do think that the day-to-day fluctuations of the market, maybe the tariff scares or the Fed independence scares, all this stuff, it's intense in the moment. But if you're looking decades in advance, odds are your portfolio will be just fine if you just leave it as is and stick to your plan, stick to your dollar cost averaging, all those things.
Yeah, and when we talk about the record highs that we've been seeing, and Jared was just mentioning some of the returns that we've had over the past few years, and then you try and match that with the state of the U.S. economy. And post-COVID, we did see a struggle with inflation really rampant. A lot of everyday Americans were underwater, yet we had these double-digit gains in the stock market. So how do you really square that when it comes to assessing the status of the economy while also what we're seeing with stocks at record highs?
That's a great question. So we've seen this phrase, a tale of two economies, right? I think you pretty much have your asset allocators and then those that aren't in the market. And there's really been a clear winner and loser story here. And if the short of it, if you've been in the market, you've done very well. And if not, your dollar has lost purchasing power dramatically over the last 5 years. I think since 2020, we've probably lost 25, 28% of $1's purchasing power. So that is very significant. And if you were in the market, then you've been able to keep up or beat that, let's say, loss in purchasing power.
Mm-hmm.
But if not, you really can't buy as much as you could. So these are structural issues that really point to the importance of investing, I think. But it also points to the probably the widening inequality gap as well.
Maybe the types of companies you invest in too, because those that are more exposed to that lower income consumer, they have been reporting a little bit more of a struggle.
You've brought up a great point. I want to launch off of that because Phil, you sent us a chart a few hours ago. Dollar General and Dollar Tree, two companies that are known to do well when the consumer is feeling a little bit off and their pockets are a little bit pinched. They are outperforming most of the other retail companies, especially the big box retailers this year. Not only that, they're outperforming NVIDIA. So talk to us about that phenomenon. What do you think of that?
So when I saw those numbers and I sort of put the stocks on a line chart, I was very shocked. And because NVIDIA is the story of the year, right? Everyone loves this stock. Earnings are the Super Bowl, all this. But Dollar Tree and Dollar General are beating it by, I think, by double digits still.
Mm-hmm.
And the CEO of Dollar Tree at the last earnings call said the majority of their new customers in the last quarter were six-figure households.
Yeah.
So that's I read that and it was a baffling stat because you wouldn't assume that a six-figure high-income household is going to a dollar store. And
I will say I love dollar stores.
Likewise, I love a dollar store. But that points to this sort of flight to value, right? So everyday consumers, regardless of income bracket, are looking to stretch their dollars more. And that goes to the loss of purchasing power. It goes to inflation. It goes to high interest rates. So all these things, it is pointing to a constrained consumer, I think.
Yeah, and when you talk about the dollar, I mean, I think year to date, we've lost about 10% compared to other types of currencies. And it's interesting to look at that and then look at gold, which is now at record highs, right around
let's talk about gold.
$3,700. I mean, where is that mostly foreign investors piling into gold? Is it the expectation of rate cuts? What do you think has been driving kind of that side of the market?
That's a great question. I think part of it is a lot of governments and central banks are buying gold, right?
Bingo. China, Russia.
Yep.
Yeah.
So I think that's, I don't know what percent they're driving, but that's probably a huge chunk of it. And then you have Bitcoin as well has seen a similar, very strong year. So you have central bank and government buying. I think you have retail catching on to this gold trade. And then you also have the general narrative, I think, of you want to hedge against dollar debasement. And gold and Bitcoin are the best ways to play that, according to most people.
What do you think of all these Bitcoin treasury companies? Not just Bitcoin. Now we're seeing Ethereum treasury companies, people piling into the micro strategy, which almost just got added to the S&P 500. Didn't quite make it, but Solana too. What do you think of all this phenomenon?
First of all, I think with the micro strategy not getting added, there were definitely some politics at play there. I don't know the details, but
Sure.
it was so eligible, right? But it didn't get picked. And as far as the broader Bitcoin treasury trend, this, you could say from a very high level, is a bet that the dollar will continue to lose its value and Bitcoin will continue to appreciate over time. So why wouldn't you want your balance sheet to be denominated in the asset that's going to appreciate rather than get debased? So I think very simply and from a very high level, that's what we're looking at. And again, you might be able to point out some froth in the market because there's been a lot of these popping up. And I think we're seeing other crypto assets being put on balance sheets as well. So that also suggests, okay, are we getting overextended here? But right now, I think the train is still going to keep going.
All right, we got to get to our runway battle today because on Who Are It Better, we are crowning a market leader and we are pitting the mega cap giants against their small cap cousins. On the left catwalk struts the mega cap moat, armor-plated balance sheets, thick margins, and a wardrobe of buybacks. When the lights flicker, these names don't flinch. They just tighten their costs and keep the cash flows a-coming. On the right runway, we've got the small cap scramble, cyclical energy, turnaround stories, and tags that still say discount. When the economy accelerates and money gets cheaper, these names rip. But rate cuts are a double-edged sword because if the Fed is too late, small caps, they get torn to shreds, while large caps, well, they suffer too, but typically a bit less. So Phil, you don't need to pick a religion here. We just want to know which closet you're wearing and why. Who wears it better over the next year, mega cap moat or the small cap scramble?
That's a hell of an intro. I would say from this point to year end, if we get, let's say, 2 to 3 rate cuts, I think small caps will do very well. They're very interest rate sensitive, and I think large caps, you could also argue, are getting a bit overextended despite the earnings that have been so good.
What if we only get 1 cut this year?
Or 10. Like the Fed's really behind the 8 ball. That's not a good sign either.
1 cut, I would probably lean more towards mega caps, but I don't think we'll only get 1 cut. I think we'll probably get 3 by
Really?
December. I think so.
Yeah. And what do you think will drive that? The continued deterioration of the labor market, or do you think the inflation side of the picture, if that comes in hot this week, could that maybe give the Fed some pause?
I think even if inflation comes in hot, the Fed has pretty much conceded that they are going to let inflation run hot. So I think they're going to look at the labor market, and they're also, of course, the political pressure, whether you say they're buckling or not, it's definitely a factor. So I think they're going to let inflation rise, even if, whether it rises or not, they're not going to be worried about that right now.
Phil, at the beginning of the show, I mentioned you are an accomplished author, and I have read your book, Life Between Moments. I love it. Tell us about your journey into writing fiction and how that's kind of maybe jived with your job here at Morning Bell.
That's deep in the archives there. I think writing fiction has helped me just be a better writer in general, right? It helps me use different literary tools in my financial reporting, and I think it makes me understand the psychology of things a bit better. And yeah, that book really, I wrote it when I was at Business Insider, and I would go home after work and spend maybe 30 to an hour on it a day, finished it in a year, and then published it. And it has nothing to do with markets, nothing to do with Wall Street, but it was a great passion project of mine at the time. And I'm honored you even know about it. So.
Hey, I encourage everybody to read it, download it, get the Kindle. Definitely some great stories in there. All right, so what did we learn here today? We talked about the September effect, and that's the seasonality play. It's just a tendency. It doesn't mean you have to get all scared because September tends to close down, but we do have some other orange or yellow flashing warning signs, and some of those have to do with the fact that the Fed might be a little bit behind the 8 ball. We got a deteriorating labor market. But what's most important is that investors keep their head on their accounts and not necessarily responding to the news on a day-by-day basis because the market itself, the S&P 500, yes, it's concentrated, but we've seen this concentrated persist for long periods of time over history. So that's going to do it for today. We got to wind down things here at Stocks in Translation, but be sure to check out all our other episodes of our video podcast on the Yahoo Finance site and mobile app. We are also on all your favorite podcast platforms, so be sure to like, leave a comment, and subscribe wherever you get your podcast. We'll see you next time on Stocks in Translation.
Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
It's 12 o'clock.
It's time for Yahoo Finance's Market Minute. U.S. stocks climb as oil prices surge amid Russia sanctions. Wall Street also parsing through a fresh batch of quarterly results after Tesla and IBM earnings fell short. And looking ahead, results from struggling chipmaker Intel will take center stage after the bell. Binance Coin, the cryptocurrency created by the Binance Exchange, seeing a pop in today's trade. That move higher comes after President Trump pardoned Binance's founder, Zhengpeng Zhao, who goes by CZ. He served prison time after pleading guilty in 2023 to violating anti-money laundering requirements. And Honeywell reporting a beat on earnings and sales for the third quarter. The company also raises its full-year earnings guidance. The new outlook now including the impact from the spinoff of Solstice Advanced Materials. And that's your Yahoo Finance Market Minute. Scan the QR code below to track the best and worst performing stocks of the trading session.
Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blickery, your host, and with me is Yahoo Finance senior reporter Brooke DePalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. And today we're going to be talking about how investors can position themselves for an AI economy of the future, from driverless cars to personal robots, maybe even flying taxis. And today's guest is bringing some actionable investment ideas, especially from the energy side of AI, which leads us to our phrase of the day, energy infrastructure. Might not have the sizzle of NVIDIA GPUs, but it covers the nuts and bolts plays that are absolutely critical to the AI trade. And for market show and tell, we're going to be talking about dividends, the second cousin of stock buybacks that doesn't get as much press, but can be the key to more stable returns. And this episode is brought to you by the number 250. That's the total power that OpenAI's Sam Altman says data centers could need by the early 2030s. We put that in perspective for all of you Back to the Future fans. And guess what? Today we are welcoming Rob Thummel, who is a managing director and senior portfolio manager at Tortoise Capital, where he has been investing in energy and infrastructure over the last 2 decades. He's been a prominent voice on how AI accelerates electricity demand, saying that electricity is the new oil, which we're going to dig into. Rob, it is great to have you here.
Thanks for having me.
All right, let's begin with your take on how the AI trade is playing out from an energy perspective.
Well, electricity is becoming the new oil, Jared, because if you think about it, we need a lot of electricity. If you think about it, not a lot of people think about when you hit that button on ChatGPT, what really happens. But really what happens is basically it ends up being 2 things, data and electricity. You need 2 things basically for ChatGPT and all AI to function, data and electricity. So the electricity demand in the U.S. has actually been flat for the last 2 decades. That's about to change. It's already changing, but it's going to start accelerating significantly over the next 2 decades. And as a result of that, we're going to need all forms of energy supply sources to generate that electricity.
All right.
Yeah, is this a moment in your career that has stood out to you by chance?
Oh yeah, absolutely, Brooke. Yeah, because it's like the shale revolution. I was around for the shale revolution, and I still think that U.S. shale is one of the probably the most underappreciated, but one of the most significant energy technologies ever to happen, because shale technology allowed the U.S. to become the largest oil and gas producer in the world. It's really changed the shape of the energy sector long term. Now we've got electricity. That's about ready to change the shape of the energy sector for the next couple decades as well.
Yeah, something to look out for. But I do want to get to the phrase of the day. It is energy infrastructure. That's right. That covers the physical systems that produce and deliver energy, from power plants to pipelines, transmission lines, storage, export terminals, and on-site systems. Think about those data center cooling, backup power, and controls. Yes, it is lots right now, but it all keeps homes, businesses, and data centers supplied with the energy that powers our lives. So, Rob, you've seen this incredible demand really ramp up as of late. From your perspective, what has someone like you who's worked in this energy sector likely for years, literally you started out your career within this, what has this been like for you?
Well, it's busy, right? Because it's just trying to figure out how's this all going to come together, right? The energy sector's evolving and it's evolving very quickly. You mentioned Sam Altman. We have some of the greatest minds in the world now are focused on this AI and the AI and the future economy. But what people don't realize is, look, there is no AI without infrastructure, as you highlight. And so there's a lot of opportunities for investors, and just figuring out where the best opportunities are. That's what I get to do every day, which is actually kind of fun. But there's a lot to do.
All right, let's talk about a couple names here. Just in terms of the real estate plays, I know there are a couple that you're looking at. One of them is a former blockchain tie-in that's kind of remaking itself, and we see this a lot in a lot of times companies will just do a makeover and suddenly they can repurpose themselves in a new industry. But this is really interesting, the way you're
Yeah.
looking.
No, that's right, Jared. So there's a lot of so AI is transforming a lot of things in our lives, right? But it's transforming companies. You mentioned one. Riot Platforms is a classic example. Yeah, they're going to be blockchain. They're going to do. They have a lot of power, basically. Ultimately, what they started out, they said, okay, we have access to a lot of power. Okay, now what they figured out is, oh, by the way, what needs a lot of power? Well, AI development, AI data centers. And so they're transforming from really being a Bitcoin miner effectively now to a data center operator. They've totally transformed their business from kind of a commodity-based business to a long-duration fee-based business. And so as a result, the valuation of that stock has increased significantly, and we still think it has lots more room to run.
All right. Go ahead.
I do want to add, though, because what sort of investment does Riot need to make in order to make this pivot? Is it underway? I mean, it doesn't just pop up overnight.
You can't just change your name, although that will give you a stock pop.
Those are great observations and questions. What Riot needs to do is they need to build physical data centers. They basically need to build these big boxes, right? I mean,
it seems like a promise, though. When does it actually happen?
Well, they have a data center. They hired a chief data center officer, I think, who has got a background in building data centers. So they're going to make an announcement, and probably within the next, hopefully in the next few months, where they will give a little more clarity on precisely what they're going to do, Brooke. But I think what they're going to announce is something to the extent of, they're going to build these massive data centers near their electricity generation sources in Texas, and it'll probably be backed by a contract with one of these large hyperscalers. I don't know who, but by probably one of these larger hyperscalers.
Yeah, lots to look out for in this environment.
All right, here's another one. Evergy Corporation, ticker EVRG. I know you're looking at that, and maybe Modine. Just give us some of the things that you see in these companies.
Well, Evergy is the power provider to Travis Kelce and Taylor Swift, if you didn't know that, in Kansas City.
Oh, wow.
Stock goes on, but that's it.
So that might be worth something, but it happens to be where I'm from as well. But regardless, I'm not joking about that. But the serious part about Evergy is Kansas City has become an area where there's a lot of data center activity. Well, electricity's, you're going to need a lot more electricity. So Evergy is really an interesting story because for decades it's been a very slow growth electric utility, really boring, and that's fine. That's been fantastic for a lot of investors. It's about ready to accelerate its growth rate. It's another transformation story because what's happening is these data centers are going to come to Kansas City. You need to, they're building facilities, and Evergy's going to electrify or power these facilities. So they're going to potentially double their capacity in terms of electric generation. That's going to probably result in the growth rate for Evergy rising by about 50%. It's a utility, so if that happens, we think that the stock will re-rate to a much higher multiple, and that'll be good for investors.
I want to break away now, get into some other plays, and this involves dividends. And this is our market show and tell item of the day. We've been talking about these energy plays, and let me just give a quick primer on dividends. They are the cash payments from a company to its shareholders, usually from profits, and they're optional. They're also taxable. You got to watch out for that, and a key part of a stock's total return. And just to emphasize that last part, we tend to talk about stock performance only in terms of what the share price returned over a period of time. Like NVIDIA is up 35% this year. But when we include dividends, that's what we call the total return. And that's a more accurate representation of a stock's performance. You can get apples to apples with that. So tell us about how you approach dividend plays and then just kind of how you think about them in general.
Well, this is something we're really excited about at Tortoise. We've been providing investors with current yield, current income for decades.
And energy is a great place for dividends.
That's exactly right, Jared. Energy's been a great place for dividends. And so now, if you can get some income for investors and have an AI component to your potential total return, it's kind of a double bonus, right? And so a company like Williams Companies is a classic example. It's an energy company. It's a pipeline company. Stable, consistent cash flows, because that's what you need, right? You need stable, consistent cash flows to be able to continually pay out that cash that you generate to the shareholders. That's what Williams does. It operates one of the largest pipeline networks in the world. We all need to use more natural gas and have been using natural gas for decades, and we'll use it for many more decades to come. Williams also, though, is building electric generation in New Albany, Ohio, to support Meta's Socrates data center there. And so it's called behind the meter. It's a technical term, but it basically means it's not part of the electric grid. So with Williams, you get the dividend yield because of the pipelines and the natural gas flowing through those pipelines and the fees that Williams charges to customers. But then you get exposure to this growth potential because of this electric generation that Williams is building and basically charging Meta now a fee to generate the electricity from the natural gas that Williams transports into these various facilities.
Yeah. Go ahead.
Just quickly, if you're a first-time investor and you're looking at a dividend stock, what's the timeline look like to sort of hold that sort of investment?
Yeah, that's a good question, Brooke. I'd say forever, right? You
Right.
get a good dividend yield. Now you have to make sure that dividend's covered. That's a very good question, though. I mean, the timeline is forever if you're confident, if you can gain confidence that that dividend's going to be consistent for decades, or I don't know about forever, but let's just say forever. And if they can grow that dividend, that's another important thing. So we spend a lot of time, analyzing the companies, their historical returns, how volatile their cash flows are, because companies that have more volatile cash flows, well, they're less likely to maintain steady, consistent dividends.
Right.
Less volatile cash flows typically mean more steady dividends.
And I just want to highlight all the viewers out there, you can find all the dividend information for various stocks on the Yahoo Finance site. And you mentioned a key stat, the dividend yield, and that is the dividend as a percentage of the stock price. So you can think of it almost as an interest payment that you might receive from a bond. So what do you look for in terms of dividend yield, and how do you find those that you feel confident in are going to be able to make that dividend payment in the future, as you said, maybe forever?
Yeah, well, we look at the nature of the revenue growth. We look at the nature of the business. You got to really look at the assets, right? Do these companies, Warren Buffett likes to talk about economic moats. That just means how stiff is the competition for the business, and how easy is it to replace these businesses or these assets that are generating the cash flow that are paying these dividends, right? And if you have these wide economic moats where it's very difficult, if not impossible, to replace the assets, then you can feel pretty confident that the cash flows that underlying asset or that underlying company is paying are probably going to continue to be paid for a long period of time, maybe forever. And so that's really what we look at. Who has the largest economic moat? A lot of times infrastructure assets really fit in that mold, because they're real assets.
And they don't have, the competition is difficult.
And they have these moats because sometimes they're regulated. Even a lot of regulated companies have pay high dividends. Utilities pay a lot of high dividends and they're regulated. They have regulated returns. You can feel pretty good about those type of businesses.
Yeah, we need to take a short break, but we're coming back. We're talking some jaw-dropping numbers when it comes to AI power needs and a runway showdown that pins your golf skills against your poker face. Stay tuned. This episode is brought to you by the number 250 gigawatts. OpenAI CEO Sam Altman recently got some attention when he said that this is just how much power that data centers will need by the early 2030s. It's pretty soon, right, guys? For those tracking, that's about 1/5 of the current U.S. capacity. Now, Rob, these numbers just keep getting bigger, but this all projected growth, are these numbers really realistic if it's just this projection that these big executives are putting out here?
Yeah, well, I think Sam Altman probably knows what.
Right.
I think the thing holding back AI development, Sam Altman and other tech executives have said the same thing. What's holding back the development? It's not the computing power. It's not the brilliance of Silicon Valley. It's the electricity supply, and and so I think those numbers are real. It's massive, though. You highlighted, Brooke. It's a massive.
It seems scary. It's only 6 years away.
I mentioned Back to the Future in the intro because if you remember that point in the movie where Doc Brown says 1.21 gigawatts, and he calls them gigawatts. Okay, this is 200 times that amount. And so, Rob, you and I were talking about something before the show, which is this kind of a mirror possibly of what happened in 2001, where you had all this fiber optic build up because the internet was a new thing and suddenly everybody had to have these pipes. Well, are we in danger of having an overbuild here?
Yeah, well, I mean, I think that's always something to watch. I don't think so because I do think that the technology is there, the cash flow is there. The difference I think this time is these big hyperscalers, mega cap tech, they've got a lot of cash flow.
And they're paying it out of cash, not debt.
Yeah, exactly. And they've got $250-300 billion of free cash flow just this year, and that's after they spend $400-600 billion on all this data center. So there's a lot of cash here that they're generating right now. Earning a return on that cash or on that capital is going to be something we're going to watch pretty closely, and obviously the boards of these companies are as well. But yeah, I think it's real. I don't think we'll have an overbuild. It's always something to keep an eye on, but we're a little ways away from that. Maybe 5 years from now, it's a discussion to have. But right now, everybody needs more electricity, and they need it now.
Yeah, and I do think what spooks me, though, is we're getting these notes from, say, Bank of America, and they're saying that at the end of the day, the consumer will ultimately be paying up for these build-outs, for this rapid demand of capacity. What do you make of those sort of suggestions?
And the not in my backyard movement, because nobody wants those elevated prices.
They don't. No, well, so and that's something obviously that all the constituents and including the data centers and the electricity power providers want to avoid. So there's a couple ways to do that. So there's some this behind the meter power, and I mentioned that with Williams. That solves that problem because now those data centers that Meta's building in Socrates in New Albany, Ohio, the residents of New Albany, Ohio are not going to pay for that power.
Yeah.
Instead, who's going to pay for that power? Well, it's going to be Meta who's going to pay Williams basically a fee, right?
Right.
And that's called behind the meter power. So Meta will pay Williams, and the consumers will not have to pay. In addition to that, there are some rate structures by these utilities whereby when you are a large user of electricity in a specific area, Evergy is a classic example. I'm not going to have to pay for that power. Travis and Taylor aren't going to have to pay for that for those data
Other
centers.
Kansas City residents will not have to pay for their
No, they don't have to either. Travis could afford it, and Taylor could as well. But that said, it's going to be charged to the large load, the data centers who are actually using that power. So they're going to get charged a special rate. It's a little bit nuanced, it's complex, but the bottom line is the utilities, the companies, everybody's very well aware that the retail consumer doesn't want to see higher power prices so that they can build these massive data centers and all these technology gurus in Silicon Valley make all the money off of it while it's funded by everyday people like ourselves. And so that's something that everybody's keeping an eye on.
Yeah, you could imagine that becoming a very hotbed election issue over the next few years. Maybe not necessarily this November, but going forward. I want to ask you about pure play natural resources and just take gold, for example. Now, gold isn't really part of the AI trade, but silver might be. And we've had these parabolic moves, and you could also put in maybe natural gas or crude oil at different times. Do you ever play those material resource, maybe through an ETF or in the futures market?
Yeah, well, I think what we think going forward is, if electricity is the new oil, natural gas and nuclear are going to be the future energy supply sources. So we're at Tortoise in particular, we're interested in natural gas and the opportunities there. Buying the direct commodity, not so much, but you can buy companies like EQT and Expand Energy, who are the two of the largest natural gas producers in the U.S., and they typically trade in line, generally speaking, with what the commodity price does.
Okay, interesting. Anything we haven't covered here in terms of sectors that you like or part of the data center trade? I mean, it could be cooling systems or whatever.
Yeah, Jared, that's well, we love the enablers, right? So the infrastructure that enables all of this AI development. So those are companies that produce data storage devices, right? So those are companies that also do the cooling. You're right, the heating and the cooling. That's really interesting to us as well. The cables, all of that kind of stuff. The network switches. Those are all examples of companies that are going to have significant growth tied to this data center build out, because these data centers are getting massive, they're getting bigger. Meta's going to build data centers that are the size of Central Park. So you need a lot of infrastructure and a lot of AI and network infrastructure that really enables the development of AI.
Really interesting to see some of these companies, maybe a century old, who have just totally reinvented themselves here. But we've got to take a little bit of a diversion here. We've got a classic market take on a Hollywood gab show staple, which we call Who Wore It Better. Today's theme stacks up a golf strategy and a poker strategy. It's read the green versus read the table. On the left catwalk struts read the green. For a put, you study the slope before you swing. And in markets, that means studying the business, how fast demand is growing, what it costs to keep the lights on, and whether cash flows can support those dividend payments over time. And on the right catwalk, we've got read the table. Before you bet, you watch the players. And in markets, that would be the crowd. Are investors already piled in? What's investor sentiment looking like? Is the exuberance? Is it too rational? Both matter. Fundamentals can tell you what to own, and the crowd dynamics can help you on your position, deciding when to pounce. For this market, Rob, which skill wears the current market environment better? Is it reading the green or reading the table?
Oh, I think it's reading the table.
And here we are. So let's make our bets here. Tell us how you would use that information, how you read the table, investor sentiment if you're trying to get into a stock or out, or
yeah,
the
there's a lot of
market in
momentum,
general.
right? There's always momentum stocks, right? And you can kind of see that in daily trading volume. So you can see, well, you can use technical analysis, things like the 50-day moving average versus the 250-day moving average, and look at technical analysis to see when a stock crosses over its 50-day moving average, or the current price is above its 50-day moving average or below it. So there's a lot of things like that where you can get a sense for, are the masses buying or are they selling?
Yeah. So more tactical. And I'm just wondering, in general, what are you focusing on right now? Is it more of the long-term bets, or are you spending your days trying to figure out how to kind of navigate some of the ins and outs in the day-to-day management?
Well, yeah, at Tortoise, we're probably more reading the putt. You're right, Jared, because I mean we're studying the cash flows. We're fundamental investors at the end, ultimately, and we look at every single stock and analyze its cash flows and project its cash flows. And that's why we like this AI infrastructure trade, because if you look at the growth potential and the cash flow growth potential of a lot of these enablers of AI, it mirrors really the capital spending growth that you're seeing out of these hyperscalers. So if we're going to go from $600 billion today of hyperscaler capex spending to what Jensen Huang says could be maybe $3 to $4 trillion by 2030, that's
another jaw-dropping number.
Not a jaw-dropping number, no, but it's 30 to 40. That's 40% annualized growth between now and 2030. Well, that same growth, that money is being spent with these AI enablers, right? It's being spent with the data storage device companies to manufacture those. It's being spent with the network switch operators. It's being spent on cabling. And those companies that perform those services and provide those services are growing at the same rate as this CapEx spend. And so that's kind of more reading the putt, I guess, maybe than going with the masses, right? So
for investors, though, who see this market and they see all this frothiness, all these high market valuations, they really see this big trade around the AI demand. How do you sort of understand when and where to get in right now?
Yeah, well, so that's a great question, Brooke. So we've looked at this really closely because, yeah, there's a big question out there about, are we in an AI tech bubble? And we don't think so, because when you look at the previous bubbles, we look at the price earnings ratio, right? So have the stock prices went up faster than the earnings, and so are the earnings not there to support the rise in price? And when that ratio gets really high, that would mean maybe we have close to a bubble. I think in the tech bubble, the price earnings ratio of the S&P 500 was 171 at one point in time.
Eye-watering.
Yeah,
it
is.
It
That's
is.
insane.
It's not. We're nowhere close to that now. We're in the 30s, right? And so what that tells me is the earnings. Yeah, the stock prices have done phenomenal, but the earnings have kept up, right? So, because the price earnings ratio really hasn't changed much. So the earnings have kept up with the stock price performance. So, but that's really the one thing that we look at. We like to find stocks, obviously, that have low price earnings ratios, but growing earnings rates. And so then maybe you can get them at a cheaper price and then derive some return from that.
And certainly we've seen investors flock to these stocks after their earnings have proved otherwise.
All right, and we're going to have to leave it there, but just kind of backing up for a second, I like how we led into this whole discussion with the energy infrastructure trade at large, looking for kind of pockets of investment opportunity outside some of the glam and glitz that you might hear about NVIDIA in your daily financial music travels here, and also dividends. Something I've kind of overlooked over the years, but I recognize the importance of them. It's nice to have that cash flow, and especially if you can reinvest those dividends, well, then you get compounding magic, and that's something that Warren Buffett talks about. Just in terms of the numbers, they're just astronomical, and I've been asking a few different guests here what their take is. Are we in an overbuild stage similar to 2001? Almost everyone has the same answer, which is no, and that we are not supporting this CapEx, these expenditures with debt. We're doing it with good old-fashioned cash, which has been earned the old-fashioned way, which is earned. And on that note, I'm going to leave it there. So we are winding things down here at Stocks in Translation. Be sure to check out all our other episodes of the video podcast on the Yahoo Finance site and mobile app. We'll see you next time. Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Jared Blickery, your host, and with me is Yahoo Finance senior reporter Ali Canal, who's here to connect the dots and to be that bridge between Wall Street and Main Street. And today we've got a former pit trader as our featured guest who's sharp with market technicals, and we're going to be tackling all the recent market action as the shutdown drags on and earnings season picks up. Our phrase of the day is commodity futures. Our guest spent 14 years in the COMEX pits, and we're going to get her take on the story being told by gold, set for, by the way, its 49th record high of 2025, and crude oil, which is flirting with 4-year lows. And on today's Market Show and Tell, our guest is bringing in her extended family, what she calls the modern family market analysis, from grandpa and grandma to big brother and sister. And this episode brought to you by the number 20.5%. That's how much tech profits are expected to grow from last year in the third quarter. How much is this still a Mag 7 story? And without further ado, we are welcoming Michelle Schneider, a veteran floor trader turned chief strategist over at Market Gauge. She is the author of Plant Your Money Tree and has one of the sharpest eyes for chart patterns and technicals in the biz. She is a Yahoo Finance regular, but this is her first appearance on Stocks in Translation, and we are incredibly lucky and excited to have you here. Thanks. It's great that you could finally make it out here.
What a great introduction. Thank you, Jared and Allie. It's so wonderful to be here.
How about your big picture market analysis for us? How do you see things going right now?
Well, we may be in our late stage innings of the bull market, but that doesn't mean that we're anywhere near the end, right? And so right now, the fact that we have lived through rising debt, government shutdown, tariff news, possible cockroaches in the credit market, and we bounce right back, just shows you the resiliency of this market. And so right now, you have to be a bull because those who've been trying to pick a top have not been happy.
Yes.
Well, it seems like if it's a down day, it doesn't stay down for too long. And that brings me to our phrase of the day, which is commodity futures. Now, these are standardized contracts that let you buy or sell a commodity. So think gold, oil, or even coffee at a set price on a future date. Now, producers and end users turn to futures markets to hedge against price swings, while traders use them to speculate, helping to deepen the market by adding liquidity. Now, futures can be highly leveraged and risky, but we're now seeing more ways for everyday investors to access them through ETFs. So, Mish, what does this shift look like for you, especially as someone that's really been elbow to elbow with traders in the COMEX pits?
Well, I think the whole advent of ETFs has been amazing for getting mainstream investors. And I still feel, though, even at this point, a lot of commodities are ignored. I mean, for example, even though people had access to buy something like gold through GLD or silver through SLV, really it's only been recently that we're starting to hear mainstream people talk about it on the media. And yet, that's been spectacular. In fact, Jared, I can remember you and I talking 3 years ago.
We did a webinar, I think.
Yeah, and also I was live with you in the studio in front of charts, and we pointed out gold.
Yes.
And so here we are. It's literally doubled.
You were an early bull in the gold trade. I will say that. You know what? One of the things, and we can break this down real quickly, I noticed in GLD, and that's the ETF for gold, one of the bigger ones, there is a bearish engulfing candlestick. And I love candlesticks. They kind of tell a story. But I'll tell you what, despite the name bearish engulfing, gold is right back up there today, and it is just shrugging off news. What do you make of this chart pattern and just the market in general?
Well, you know, it's funny because we were talking about Dan Ives just recently brought up a Mae West line, too much of a good thing can be wonderful. And I think that's what we're seeing in gold. But, you know, from a more serious standpoint, one has to ask, why would the metal ignore so much something like a bearish engulfing? It had a huge drop last week. And obviously, there's some real good fundamental reasons to be long gold. And number two is, what is it really saying if you're looking at it as a mirror, a reflection of the cracks underneath all this euphoria?
Yeah.
So what could derail this record run in gold? Is it a recession? I mean, it seems like central banks also around the globe keep buying a lot of gold, too. That's propping up the trade.
I always say what would break the back of gold would be if all of a sudden we greatly reduced our debt, not happening yet, and peace broke out in the world. We've had hints of peace, but hardly at the point where gold could say, okay, there's no more real crisis. And of course, our trade relations have been stressed. And we know that one of the biggest buyers of gold has been China. So I think there would have to be a major shift in that people would start to relax about these cracks becoming much larger fissures in order for gold to actually start moving down again.
Before we get into market show and tell, and we're going to broaden this markets discussion, I want to ask about crude oil because, as I said in the intro, almost down to 4-year lows, closing around $55 per barrel. That's huge. What do you see there?
Well, there's a few thoughts on that. Number one is the mainstay of commodities is supply demand. These are raw materials. They're not stocks. They're not companies.
Good point.
Right? So what makes a raw material interesting is when you have a shift in the supply and demand. And right now, there's been a lot of talk about an oversupply of oil. We also know from a political standpoint, not to get political, but we know this administration really wants to drive the oil prices lower. What kind of deals they might have made along the way has certainly influenced how much oil is out there. But here's the other side of the supply demand. It's kind of like the housing market in a way, right? If you get so much oil and the prices get too cheap, then you start to see refiners stop refining, drillers stop drilling, because they cannot afford
They're
to
not
operate.
incentivized to operate. Sure.
Right, exactly. So now all of a sudden, if you get any kind of pullback in terms of the supply and rise in demand, which could also happen for a myriad of reasons, not the least of which is that AI data centers need energy, and oil is certainly, as far as I know, a source of energy, along with natural gas. That's where you can see the shift. So a lot of people, including myself, have been waiting for that to happen. But now, just in terms of the timing, it looks to me like we're not going to see a shift in terms of supply demand, possibly into 2026, when we're talking about crude oil.
Right. I want to shift gears a little bit, and it is time now for Market Show and Tell. Today, our guest, Mish, you have brought something to share, and it is your Modern Family Market Analysis, which features different ETFs and different family roles. And rather than me laying out, I'm going to let you do the heavy work.
Well, yeah, when I was a commodities trader, as you said, for so long. So when I got into the world of stocks and economics, I had to have a way to explain to myself not just what was important to look at, but the relationships and how that impacted the market. And as I was thinking about things, I started to realize that like the Russell 2000 was almost like the grandfather of the U.S. economy.
Yes.
Right? And so I created a carrot to go with that. And then I thought, oh, retail, well, that's 70% of the gross domestic product. And that was like my grandma who got so happy when she would go shopping. And then from there, transportation, obviously, the Dow theory is still very much a thing, became a character. Semiconductors obviously has been the Wonder Woman, sister semiconductors of the whole. And now all of a sudden, Big Brother Biotechnology is waking up, which is great to see because that could be cyclical and non-cyclical. Regional banks, and that's so key to the family because we saw regional banks starting to fail last week before we saw that.
Little scare.
Even though, the little scare, the one or two cockroaches. And then, that's all of them, but I added cryptocurrency as a character as well.
Who's the cryptocurrency character?
Well, it's big. It's really Bitcoin Bro.
Bitcoin Bro.
Bitcoin
very,
Bro, yeah.
Very appropriate.
Yeah.
So what is the family structure telling you right now? You're big into technicals. What do you see playing out in the near to intermediate term future?
Well, clearly we're seeing the small caps have a nice little pop here. They were higher than they are right now, but nonetheless, they did not fall apart the way that, say, regional banks did. To me, the most interesting, and probably if we had to pick one besides semiconductors, because you don't want to see semiconductors fall. That would really hurt the whole market. But you have to watch Granny Retail. She's always been my favorite character because if the consumer is not buying, we know things are going to turn uglier. And right now you have a niched kind of a consumer market. There are areas that people aren't buying, and some people are just really basically on the lower end of the economics spectrum going more for staples. But nonetheless, there's still a lot of money being spent by the wealthiest. And so XRT, that's the ETF, speaking of ETFs, in 2021 made a high of about 104, and it's only trading at around 85, 86. I haven't looked at the recent number today, but that's still a great distance from all-time highs as we're making all-time highs.
Sure. So a big laggard trade.
Exactly. And I think you have to keep your eyes on that in particular, because at what point, the expression I like to use is, what point does a weak link become an anchor?
Oh, interesting.
And it does remind me of something I just wrote about, which is how the entire economy seems to be levered to AI, which ultimately is unproven. You were just talking about those wealthy consumers propping up the economy. They're propping up the economy because their portfolios are doing well because of AI. So
virtuous cycle here.
Yes, a circular trade, which we are seeing with the AI giants themselves funding each other's growth. So how concerning is that concentration risk for you? You mentioned that quote, sometimes too much of a good thing is a good thing. I guess when is the point where we start to second guess the nature of those trades?
Well, that's a great question. So, one of the concerns that I read was that the capex right now of the biggest companies like Google and Amazon and Meta and Oracle is about 800 billion, and they can absorb that. But OpenAI and some of the smaller companies are trying to compete at a much lower level. And what they count on is the consumer to buy some of their products. ChatGPT, right? You get a free version of ChatGPT, but there's also a paid version. And a lot of these new softwares coming out, you have to pay for. So that's where the consumer comes in. What could absolutely hurt would be if at some point they cannot keep up with the spending that they've had because they're not really being able to engage consumers to buy things that they're creating when they can get them for free somewhere else.
We call that rubber meets the road.
Right. So moving beyond just the B2B side, which we're seeing in terms of the investments and really embracing the consumer into AI adoption, do you think we're there yet? It feels like there's still a long way to go. We were just talking about Apple hitting a record high. One of the reasons they've been a laggard this year is because they haven't been able to connect to the AI story. And part of the reason, at least from my perspective, is because their story is so tied to the consumer. And we don't really have a ton of use cases maybe yet on the consumer side. Do you agree with that?
I do. I mean, people will say all the time, oh, yeah, I use AI every day. I use ChatGPT. But we have to really see how much further people are willing to go. And there are so many companies that are introducing AI as a means to make life easier. I mean, right at this point, basically, biotech is really what I'm focused on because how much easier it's making diagnoses, access to client files, et cetera. But we'll have to see. We don't know. I don't think I know the answer to that yet. That's why I like to watch, going back to my economic Modern Family. KRE gave us a hint that maybe it was time to like stop buying, take some profit and buy a dip, like today would have been the day on the open. Today being Monday, of course. And so it's going to be the same thing. If you watch the rest of the family, semiconductors would have to really have a major reversal, number one. And number two is we would have to see really XRT start to fail the 50, which it's done a couple of times, but pop right back, fail and not recover, because then you're going from a caution to an actual trend change. That should be paid attention to, but we're not there yet.
Actionable. I love it.
All right, well, we need to take a short break, but coming up, we're talking big tech earnings and a runway showdown between the vanity trade and the AI glam. You don't want to miss it.
Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
to you by the number 20.5%. That's how much Wall Street expects tech earnings to grow in the third quarter compared to last year, by far the fastest of any sector. That's according to Bank of America. And if you zoom out to the core AI sectors, tech plus communication services, together they're on track to drive about 64% of the S&P 500's total earnings growth this year. So Mitch, it's not all about AI, but AI is definitely a big slice of the pie here. So when you look at the future of earnings, especially heading into the end of the year, what are your expectations?
Well, again, we have another divide, as you mentioned. So we have Mag 7 looking at north of 17% in terms of earning growth. And we have the other 493 looking at about 6 or 7% of earnings growth, which is actually good because at least
you point out as positive.
Yeah,
yes.
that is a positive. Growth is growth. But at the same time, I think that, like I said, we have to really watch the CAPEX, number one, especially of the companies that don't have meta money, if you will. And secondly, though, we also have to look for the new opportunities, and that's what makes it so exciting. Where are we branching out in the world where AI wasn't necessarily a factor and now becomes a factor? So biotech we mentioned before. I know, I'm not sure if this was the right time you wanted to bring up the vanity trade.
Yeah, go for it.
Okay, well, so one of the things that's happening because of the diet drugs, and I like the diet drug companies, Novo Nordisk and Eli Lilly in particular, but even Viking Therapeutics, because I do believe that regardless of what happens, whether we wind up in a recession or not, is irrelevant to the population. There's a 38% obesity rate in this country alone. If you take just a small fraction of them that have more affordability and availability to get on a diet drug, people are doing it. I mean, if you see people at a party you haven't seen in 3 months and they've lost 20, 30 pounds, you could pretty much guess that there might be GLP-1 involved with that. So then what I'm saying is that so now what happens to this new, what I'm calling thinner consumer? And so that's where AI is coming in. Like, so for let's example, you want to see yourself thinner. AI can actually take a picture of you now and reduce your weight by X amount of pounds so you can see what kind of makeup might I wear, what kind of clothes might I wear. Ulta has a thing now where you can change your hair color. I want to see what I look like as a platinum blonde, you know, that kind of thing.
I could waste a lot of hours on these filters.
Too much of a good thing.
But it is all about the glam. And what's so exciting, it's almost like it makes a lot of sense that as we're seeing all these young people making money with their Robinhood accounts and buying Bitcoin and really basically following the Reddit flow of stocks in AI, we're also seeing more and more people actually being really open about the fact that they're on the diet drugs and what it's doing for their life and their skin and nutritional habits. We're seeing fast food stocks go down while we're seeing healthier options go up. You know, I think this is really, really exciting, not just through AI, but as a real culture shift for people who yo-yo dieted but never had a way to sustain weight loss. They're going to come out big and they're going to spend money because they feel good.
That is an amazing AI use case that I hadn't thought about personally. When I think AI derivative trades, I think utilities, and you know, of course, there's all kinds of things that go into the data centers like power generation. And what about some of these? I'm almost going to call them traditional AI derivative trades, even though we're just kind of newly into this space. What about some of those?
Well, certainly I love to look at the infrastructure. As a commodities trader, it's kind of like raw materials, right?
Sure.
And clearly we need energy and utilities to run the AI. And even though oil has been under a lot of pressure, natural gas keeps trying to pop. And so if you're looking at natural gas right now, it's been trying to pop back up over 350. It goes back down to around 3, then gets back to 350. That is actually something we have in such excess here in the U.S. We're high natural gas, especially where we live in New Mexico in the Permian Basin. And I'm looking at other forms of energy, like, you know, Constellation has been a great trade this year. Nuclear energy, of course, we've been in uranium forever. So I think it is important, and they're talking about projections of like demand going crazy in just 4 years from now with AI data centers. I think that's a really good place to look, and all of the areas that would conduct the energy to the AI centers as well, some of that other infrastructure.
And when we're talking about commodities, one thing that's made headlines is just the rare earths, and that's obviously central to U.S.-China trade relations. What's your expectation on rare earths? Is this something that we can start to mine on our own or maybe partner with allies, or where do you think this goes from here?
Well, again, let's go back to supply and demand. So right now, we did not have much supply here in the United States, even though MP Materials had their SPAC introduction years ago. I think it was like 2019, maybe 2020. I can't remember exact date. And a SPAC, at $7, now you're seeing that thing go crazy. So I think that clearly the stocks may be going up faster than we actually can switch from producing outside of the U.S. into the U.S. However, we do have capabilities here. And so California mine is where MP is, and I know in Nevada now they're looking at rare earth. I think you can't run all of this without rare earth, so it's not like the need will go away. But I think you have to kind of watch the balance again of things getting a little bit too frothy ahead of themselves before we actually have the ability to produce them in the U.S.
We got to do a hard pivot now, just a few minutes for Hollywood's favorite gab show, Derivative. We're going to call this Who Wore Better. On today's runway, we're pitting the vanity trade against AI glam. So on the left catwalk, health and beauty names strut with new confidence. Think wellness, weight loss meds, and a whole lot of self-care spending. That's your vanity trade. On the right, AI superstars. They own the spotlight with data, chips, buzz. You know who they are. With all the focus on AI, it's easy to forget that GLP trailblazer Eli Lilly beat out 5 of the Mag 7 names in the first 2 years of this bull market when it shot up 180+%. But today, Mish, we're asking you about the current market environment. Does vanity outpace the machines, or does AI steal back the spotlight?
Well, I like to bet on the tortoise rather than the hare. So if we're looking at vanity as the tortoise, I think eventually, because it does actually change society beyond looking at a computer or a phone in a real way. And I also believe that it'll be good for people who have been so used to sitting at home looking at their AI instruments to help them produce whatever it is they're producing in work, go out and mingle more. And so I'm going to root for that.
All right. Excellent choice. And guess what? That kind of does it for our time here. Brief recap, though. I want to dial back to the beginning. We opened up with our phrase of the day, commodity futures. We talked about that gold trade, and it is just astounding to me to see gold poised for another record close after that big bearish candle that we got Friday. But nevertheless, that is a bull market in force. And then just thinking about the players in market show and tell that we had and the family. I'm always going to think of grandma as XRT and grandpa as the small caps, IWN. And guess what? Small caps are doing pretty well recently. And then you put it all together with the new vanity trade, which, by the way, is an AI derivative trade that I'd never heard about before or never thought about before. Very compelling stuff. And Mish, so thankful to have you back on the YF Network and on Stocks in Translation for the first time. So that's going to do it on our time today in Stocks in Translation. Be sure to check out all our episodes on the Yahoo Finance site or mobile app, and we will see you next time on Stocks in Translation.
through the markets and, dare I say, become a better investor in the process, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
It's 1 o'clock.
Welcome to Mind Your Money. I'm Allie Canal, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, we find out what Americans' finances look like in a new Yahoo Finance Maris poll. And gold prices have been trading near record highs. We'll break down the steps you can take to invest in the shiny metal. Plus, it's another edition of Ask Yahoo Finance Anything. We'll be joined by the debt-free guys who will answer all of your savings questions. One in three Americans say their financial situation has gotten worse over the past year. That's according to a new Yahoo Finance Maris poll. We're breaking down some of the survey's key findings. Yahoo Finance personal finance editor Casey Bond joins me now. So Casey, this is a very comprehensive breakdown. Let's start with how Americans are feeling about their finances. What else stood out to you in the survey?
Sure. Well, our survey results really show a country that is divided when it comes to their financial health and knowledge. At a high level, we found that younger generations, particularly Gen Z, tend to be more optimistic about their current financial standing and ability to save. On the other hand, women tend to be a lot less positive about their finances than men. And we also found that lower income households, generally around under 50K a year, are actually less likely to turn to debt to manage their budgets better versus higher earners.
That's interesting. Now let's zero in on savings. How are Americans feeling about that financial cushion?
Right. So, again, the results were pretty divided. About a quarter of our respondents said that they were very or completely satisfied with their savings over the last year. However, again, men were much more likely than women to say that they were satisfied with their savings progress. And it might seem like, women are maybe not as good at saving money, or, men are inherently better at saving money. But we had one of our reporters actually dig into this a little bit more to find out why this gap exists. And one of the reporters that she spoke to said that there are some financial challenges that are unique to women. For example, they're still paid less than men on average. And there's also this cultural expectation for women to leave the workforce or take lower paying, more flexible jobs in order to provide caregiving within the household. So that kind of gives a little bit more context to some of these results.
And if, for those that are worried about their savings, how are they planning to deal with a potential cash flow shortfall?
Sure. So when you're in a situation where your expenses are exceeding your income, there are several steps you can take, from dipping into your savings to maybe taking out a personal loan. We found that about 40% of our respondents would actually cut their spending first, which is a little bit surprising given today's economic environment and how inflated prices are. And particularly households earning under 50K, again, are the ones who are most likely to say that they would cut their spending first. Another 26% said that they would dip into their savings. 23% said that they would use a credit card, and then just 10% said that they would borrow money in some other capacity.
Thanks, Casey. You can scan the QR code below to get more insights from our Yahoo Finance Mayor's poll. More investors are turning to gold as a way to diversify their portfolios in today's uncertain financial environment. So let's break down what you need to know before investing in the precious metal. Step 1, set your goal. Gold tends to hold its value and sometimes even rise when other assets are falling. So many investors use it as a stabilizer. Typical goals include diversification and protecting your purchasing power from inflation. Step number 2, decide your allocation. That's how much of your portfolio you want in gold to manage risk over the long term. Gold has long up cycles and down cycles. In down cycles, it can drag on returns, so you might keep your allocation lower if that's a big concern. But if you're willing to sit through the weaker years, a higher percentage could pay off more in the strong ones. Step number 3, choose your form of gold. So there's a physical gold that includes jewelry, bars, coins. They offer peace of mind, but comes with that theft risk and less liquidity. Then there's something called gold mining stocks. More liquid, but also more volatile. Gold ETFs are funds that invest in gold mining stocks or physical gold. And while they do offer more liquidity, they can also come with fees. And finally, gold futures, contracts to buy gold later at a set price. They offer leverage and convenience, but also carry higher risk and complexity. And step number 4, consider your timeline. Because gold prices can swing, it's not ideal if you need the money in the short term. An extended holding period gives you a better chance of meeting your goals. And if you want to dig deeper into how to invest in gold, just scan the QR code on your screen. Well, Social Security is officially 90 years old. The program was signed into law by President Franklin Roosevelt in 1935 during the Great Depression, designed to provide economic security for older workers, people with disabilities, and those who've just lost their job. This anniversary is also a good reminder of a few key deadlines coming up. First, the Social Security Administration is going paperless on September 30th. That means no more paper checks for benefit payments, so be sure that you and your loved ones are enrolled in direct deposit or have a direct express card. Second, in October, we'll get the announcement for the 2026 cost of living adjustment. A new estimate from the advocacy group Senior Citizens League puts that increase at 2.7%. And to mark 90 years of Social Security, we're busting a few myths about the program. Joining me now is Yahoo Finance senior columnist Carrie Hannon. So Carrie, let's start with the biggest fear around Social Security that has been spreading for years, and that's that the program is running out of money. Is this
true?
No. So thanks, Allie. Yes, there is an issue here. Social Security is funded by payroll taxes and interest from bonds, right? And there has been a gap between since 2021. There has been a gap in as much that can pay for the benefits going out, and so as a result, that's been made up from taking money from what is called the trust fund, and the trust fund is scheduled to be depleted, projected to be depleted in 2033. So there will be a gap. It is not going to run out of money, but at that time, it will only have enough to pay out from the payroll taxes and the interest, which is 77% of the current benefits. So that is a huge cut. But most of the experts I have spoken to do not believe that Congress will ever let that large of a cut actually come to be. So it is not going to be run out of money, but there is definitely the threat of a lower benefit if something does not get done.
Okay, so we busted myth number 1. Let's go to myth number 2. Aging baby boomers are a problem for Social Security's future. What do you say to that, Carrie?
Yeah, again, absolutely not. This has been planned for decades. They have known that there was going to be an aging population. Yes, in fact, there are fewer younger workers. There has been a decline in the birth rate, which was anticipated. And so there are fewer people paying into the system. That does create an issue, Allie. But the real problem is that there's been income inequality. And so as more people earn more than is the cap for what gets charged, what gets levied a Social Security tax on, which is $176,100. People who earn above that, any above that, you do not get taxed for your Social Security, your FICA tax, it's known as. So as more people earn above that amount, they're not getting the extra income from people's their income as one might expect they are. So that is more of the issue here. It's not people getting older. It may just be that they're making more money.
All right, and lastly, some believe that Social Security benefits drive the U.S. deficit. Is that the case?
Yeah, here's what happens. No, it does not at all. Social Security is funded from what we talked about, those payroll taxes. It's called FICA taxes, which come to 12.4%. And that's split evenly between an employer pays half of that and the worker pays half of that. So it is completely funded by that and the interest payments from the bonds that's invested in. So the Social Security never takes money from the federal government to pay for the Social Security benefits. So in no way does it contribute to the deficit.
Carrie, thank you so much for busting those myths for us. Appreciate it.
Sure.
Well, coming up, a special type of home loan for veterans. We break down what a VA loan is, how to qualify, and how to get the best loan possible. Stay tuned.
military service in the U.S. comes with an exclusive benefit designed to foster homeownership, the VA loan. A VA loan is unlike any other mortgage on the market. They're offered through a range of lenders like banks and credit unions, but administered by the Department of Veteran Affairs, which guarantees part of the loan. Some of the biggest benefits include no down payment, no loan limit, and lower closing costs. Plus, no private mortgage insurance and the option to purchase a home and finance repairs that are completed after closing. VA loan interest rates are often lower than conventional mortgages, though they can still depend on creditworthiness and overall finances. Joining me now to discuss is veteran and former Pennsylvania Congressman Patrick Murphy. Patrick is also co-host of Yahoo Finance's Warrior Money video podcast. So Patrick, you served in both the military and Congress. Can you explain why VA loans are so important to both veterans and service members?
Yeah, listen, VA home loans are a game changer, really the access to middle class. Taking a step back, the number one wealth tool for all Americans is really your home, right? It's the biggest wealth generator. But in the military, the fact that it's the two things, it's the VA home loan and the GI Bill. But on the VA home loan, the fact that you can go buy a home with no money down, that the VA is going to say, listen, I back you, Allie, or I back you, Patrick, right? And saying, because they're going to be creditworthy, they have a job, et cetera. So it changed my life when I left the military. My first home was a VA home loan. And, for others, if it's the average home is like $300,000, right? Most folks don't have 60 grand to put down when you're serving in the military, right? When you're in that public service. So to be able to do that without that 20% down is a game changer.
And how can this help veterans not only purchase a home, but really build their wealth through home ownership like you were just talking about?
Yeah, no, this is what I get so excited about. So, we have this Warrior Money podcast. We tell our brothers and sister veterans and service members how they could have side gigs. And this is one of the biggest ways to become an entrepreneur. How do you do that? Okay. You might live in the barracks. You might live off post, right? And you get basically housing allowance, et cetera. But if you go get a VA home loan, you can go and get another property, and you can go and either Airbnb it, you can go and rent it out to other folks, or you could just flip it in a couple of years, put time into it. So a lot of folks really have these side gigs around utilizing the VA home loan, and it's been a game changer for my brother and sister troops and veterans.
And you teach entrepreneurship, right, to a lot of these vets. What's the big lesson that you see them take away, or what's the biggest question that they have in coming to you and really trying to figure out where to start?
Yeah, I think part of it is it can be overwhelming, right? So Allie, what we try, my co-host Dan Coons and I, what we try and tell folks is like, listen, if you see it, you can be it. So, I teach this to the business students at Wharton, when I teach, and it is, have confidence and bet on yourself. Your network is your net worth. So, using that network of the military, those opportunities like the VA home loan, like the GI Bill, to better yourself, better your assets, and better your financial readiness.
I love that. Your network is your net worth. That is so true. What about the challenges that maybe some veterans could face when trying to acquire some of these loans?
Yeah, listen, you don't want to get too far out of your skis, right? But that's why you should, watch our podcast, read books, et cetera. And, I'm kind of leery of going into debt, except if it's good debt, except if it is, you're going to invest in yourself for college, or if you're going to invest in a home that you turn around and either utilize it or, frankly, use it for other folks. So for me, the greatest, I've been very blessed as a blue-collar kid in a row house in Philadelphia to be able to, leave public service, to buy a home for the VA home loan, to go buy another home, and be able to basically increase my net worth. It's really been a game changer for the Murphy family, and has set my son and daughter up for great success.
I'm wearing my Philly Eagles green in
go.
solidarity.
Go Birds.
Go Birds. Thank you so much. Appreciate it.
Thanks, Allie.
And you can catch more of Patrick Murphy on Warrior Money every Monday wherever you get your podcasts. Lenders issued more than 416,000 VA-backed loans in fiscal year 2024, with the average loan amount coming in at just over $373,000. That's according to the VA. Here to talk about how veterans can secure the best VA loan is Vanessa Alanis, a certified financial planner at Black Dog Wealth. Vanessa and her spouse recently went through the VA loan process themselves. So Vanessa, let's start there. What was that experience like, and what surprised you most along the way?
Thank you so much for having me. It was actually very smooth, I have to say. The process was handled well we had a lender that was familiar with the VA home loan process. So pretty nice. And owning our own home after so many years of service was a definite treat.
So for veterans or service members just starting out, what's that very first step they need to take when applying for a VA loan?
The very first step a veteran, and again, you don't have to be a veteran, still be an active duty service member to use this benefit. But the very first thing they want to do is get a certificate of eligibility from the VA. They can get this certificate either by going online or by having their potential mortgage lender apply for it that way. Or since it's the government, we can still do it by the mail as well. But that would be the first step to make sure that they are eligible and to get that certificate of eligibility.
So you mentioned that certificate of eligibility. How does someone get that, and what else will lenders still want to see in terms of credit and finances?
Again, the certificate of eligibility comes from the VA, so they will use the VA to get the certificate from. Applying for a VA home loan is the same as applying for a regular home loan, so all of the other things will still matter. A veteran would want to make sure that their credit is in order, have their personal finances in order. They're going to want to make sure they understand how much they can afford and look at their numbers before starting the loan approval process, because they want to make sure that the mortgage loan provider is not going to make sure that they're providing a loan that the person can then pay for. They're going to want to make sure they can do that themselves. I see here that, to qualify for a VA loan, again, it doesn't have to be a veteran, it can be an active duty service member, and in certain situations, qualifying surviving spouses.
And what great thing about VA funds is that there's usually no down payment, but that doesn't mean that there are no fees. So a VA funding fee is something unique to veterans. How does it work, and how should vets navigate this?
So you're correct. There is no down payment for a VA home loan, but the VA does try to recoup the expenses of running this program to taxpayers by having a funding fee. And a funding fee is a percentage of the mortgage, and this percentage ranges depending on whether or not it's the first or subsequent use of this benefit, and if there is a down payment involved. And again, a down payment is not required, but a service member can come to the table with one. The fee ranges anywhere from 0 to about 3.5% of the loan value, and it can be financed. But this is definitely something for a service member to have be planning for as they're preparing to purchase a home.
Mm-hmm. And is a VA loan a one-time benefit? Are there other restrictions on property types for this type of loan?
No, a benefit can be used more than once. A property restriction is that it has to be for a primary residence. So a service member has to be planning on living in this house initially. But per your previous guest, if they should move and decide to rent it out, they can still use some remaining benefit to purchase another home. They would want to get a new certificate of eligibility before engaging in the home loan process for a second home to make sure that they know how much benefit is available for them. But yes, they can use it more than once. So it really can help people increase their wealth.
And any lender can choose to work with the VA. So how should veterans shop around for the best rates, the best terms? And is this search any different from someone who isn't a veteran?
It's not too different, except you do want to make sure that your lender is familiar with the VA home loan process. Because there are a couple extra documents that are and processes that are involved, such as having a VA home appraiser and the escape clause, so to speak, if your home should not appraise for the correct value. But other than that, you're going to want to shop around the same way. Who offers the best interest rates? Who has the best customer service? Those kinds of things. And an interesting fact that just because a bank may be very familiar within the military community does not necessarily mean they are providing the best rates or customer service. So I do encourage people to shop around to at least 3 different vendors if they are looking at getting a home loan.
And I'm curious, are there specific VA lenders?
There are mortgage providers who tout themselves as being VA lenders, but that just means that they choose to accept VA-backed loans. The VA does not sponsor individual lenders.
Okay. And how can veterans think strategically about using a VA loan, whether that's refinancing later, buying again after a move, or building some of that long-term wealth that you were just referencing through home ownership?
Well, I think it's important that veterans look at their full financial picture when trying to utilize a product like this and understand how this fits into their total goals, preferably using a financial professional to help them along with this. But it can help them secure housing at their different duty stations. And it can be used to build an investment property portfolio if done in the right way. So I just encourage them to look at their total financial picture and what their family's goals are.
And Vanessa, thank you so much for your insights. And you can scan the QR code below to get more information about VA loans. It's time for our weekly segment, Ask Yahoo Finance Anything. And this week, we're focusing on emergency savings and investing advice. Joining me now are John and David Ottenschneider, the debt-free guys and hosts of the podcast Living Not So Fabulously. Welcome, guys. Let's jump right in with the first question. Is it better to pay off debt or save for an emergency fund first? David, let's start with you. What do you think?
Definitely. I think that, as with most financial questions, it depends. I think one of the important things to remember is whether you're paying off debt or you're funding your emergency savings, both are working in the positive direction. They're both improving your net worth. But we encourage people to look at a dual approach. First, build emergency savings enough to cover your major deductibles for things like car insurance or home insurance. Then work on paying off that credit card debt. While you're building your emergency savings, though, make sure that you're making those minimum payments on those credit cards.
And second question, someone asks, how much money should I keep in an emergency fund? John, you can take this one.
Well, that's a great question to ask. Vanguard recently came out with a study that showed that respondents said that if they had $2,000 in an emergency savings account, their financial anxiety decreased by 21%. So maybe that is something to strive for. We have always said shoot for having a minimum of at least $1,000. And keep in mind that if you have contributions into a Roth IRA, you can withdraw those contributions without penalty or taxes. So that could always be your emergency savings account on top of your emergency savings account. And maybe contribute enough to an emergency savings account and to your Roth to be able to use a dual approach, as David said.
And question number 3 is about investing. The viewer asks, how can I invest for retirement if I don't have a 401k at work? David, what's your advice for them?
You know, this is a really common question because there are a lot of individuals working for small companies that can't afford to fund a 401k. So the best approach is to look towards your traditional or Roth IRAs. Obviously, Roth IRAs, there's some income limits on those. But the nice thing is you can contribute up to $7,000 if you're under the age of 50. If you're 50 or older, you can contribute $8,000. And if you have a side gig, you're able to set up a solo 401k. And if that's doing really well, you can contribute to that up to $23,000 a year. Or if you're over the age of 50, that's $30,500 a year, which that's a pretty good side gig.
Yeah. And final question here. Should I use a robo-advisor or pick my own investments? John, are you pro-bot or not?
If you're a lazy investor like I am pro-bot. Hire the robots all you can. If you're a more active investor or more engaged investor like David is, maybe not necessarily a robo-advisor is for you. But keep in mind that if you do decide to manage your money on your own, financial advisors and robo-advisors earn their keep, right? It takes a lot of time and effort to be able to find the right stocks or mutual funds and to manage your portfolio. And most fund managers can't beat the stock market 2 years in a row. So if you're not able to up to par with that kind of a competition, maybe hire the robo-advisor, but make sure that they're low cost and that they keep the cost of your investments below 0.5%. And make sure, that, of course, that they also invest in a diversified portfolio of low-cost index funds or ETFs.
All right, John and David, thank you so much. You can hear more from the debt-free guys on their podcast, Living Not So Fabulously. That's out every Wednesday at 3 p.m. Eastern on Yahoo Finance or wherever you get your podcast. Well, that's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter. And stay tuned for Market Domination. That's coming up next.
to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks climbing here, mostly driven by a rebound in tech and a jump in oil prices. We're digging into those stories, plus big earnings from Intel and Ford on deck after the market closed. And right now, there's just an hour to go until the closing bell. Stocks are higher. Just looking at the popular average here, you have the Dow up about 170 points. The S&P 500 is up about 0.7%. Tech-heavy NASDAQ is up about 1%. Let's welcome in now our markets and data editor, Jared Blickery, now with a closer look at the day's trading action so far. Jared.
Thank you, Josh. Nice reversal in fortunes for tech today, especially in the chip sector. We'll get to that in a minute. First, want to show you what's going on in the Dow, the People's Index here. We'll slide this down into an intraday view. A little bit of red there around the first hour of trading, but we are up about 1/3% or 165 points now. Nothing to write home about, but green is green, as they say. NASDAQ composite up an even 1% and pretty close to the highs of the day that we're looking at right now. S&P 500, fairly similar chart, up a little bit less, 0.7%. And I do want to show you what's going on in the small cap space. Russell 2000 up 1.5%. That was leading to the downside yesterday. So a reversal of fortune indeed. Also, I've been tracking volatility. I'm going to show you a 10-day chart of the VIX. We are back down to the levels kind of before we got that Friday China tariff scare a couple weeks ago. So that's good news on the volatility front. Some fear evaporating from the market, at least getting priced out there. And the 10-year T-note yield, that is up 4 basis points. That's not nothing. That's a fairly decent move to the upside there, approaching 4%. And the 30-year at 4.57%. That's up 3 basis points from yesterday. U.S. dollar index just about trading water there. A little bit green. We'll call it that. And then in sector action, as you said, Josh, energy leading the way today. We got an S4A covering the moves in the oil patch in a little bit, but tech is number 2. That's up 1.33%, followed by materials and industrials, close on its heels. All those 4 sectors are outperforming the S&P 500. To the downside, one of the leaders yesterday was Staples, but it's down 0.5% today. And communication services, that's down just a tiny bit. Here's the NASDAQ 100. A lot of green here, and you're going to see NVIDIA, biggest stock there in the solar system, up 1.33%. Broadcom up a little bit more. Amazon up 1.5%. Tesla up 2%. And I'm going to do a deep dive into the industries within tech. Here are the semiconductors. Just look at the picture. We got some dark green on your screen there. And then in software, a little bit less bullish. We do see some red. IBM, which was celebrating some nice moves recently, that's moving to the downside. But Oracle, that is up 3%. And I will leave us off on the Dow Transports. And this is one picture of red that we're not seeing necessarily elsewhere. But I will point out that American Airlines, that is up 5% today. Back to you, Josh.
All right. Thank you, Jared. And we're watching those commodity moves as well today. Oil prices surge as Trump sanctions 2 Russian energy giants. Senior reporter Inez Ferre joining us now. Inez.
Yeah, Josh, those sanctions on those 2 oil companies, Russian oil companies, sent crude oil higher by more than 5% today. We are watching WTI, which settled above $61 per barrel. You're also looking at Brent crude that settled above $65 per barrel. I spoke to Rebecca Babin earlier today, who told me that the key question will be how enforced will these sanctions be? Will China, will India be continuing to buy Russian oil? Because you have had sanctions placed on Russia by Europe, namely that some of these sanctions, there have been workarounds done by Russia. So this is, of course, an attempt to end the war in Ukraine. But nonetheless, this also happens when oil has been on a downward trend. We saw 3 weeks in a row where you saw oil going lower, and year to date, you're watching WTI that's down 15%. Brent is down 13%. So you'll recall that President Trump has talked quite a bit about keeping energy prices low. This comes at a time when those energy prices have been low.
All right. Thank you, Inez. Appreciate it. Volatile week on Wall Street so far, and we're tracking how investors are positioning their portfolios heading into a Fed meeting in the back half of earnings season. Join us now in studio, Justin Livengood, Senior Portfolio Manager at Invesco on the U.S. Growth Small Mid Cap team. Justin, great to have you on set. So more green today in this stock market, Justin. Maybe we'll start there. Do you see any signs, any signals in the stock market that makes you think, you know what, I'm concerned maybe that could derail this market in the near to intermediate term here?
What I'm not concerned about is the fact that earnings continue to come through really well, and we're about a third of the way through this earnings season. It's been positive. I think across different industries and sectors, companies are delivering at or above expectations, much like we saw in the second quarter. So that's been on the plus side. To the extent that changed, if we saw some deterioration in earnings results as we move through the rest of earnings season, that would be a concern. The other thing I guess that gives me a little pause is there's a lot going on in the sort of the fringes of the market that does worry me about the amount of speculation happening, right? I mean, we're seeing a lot of options activity, a lot of retail trading. In fact, yesterday was the busiest day in the S&P 500 volume for retail trading in 5 years. So there are a lot of people in the market at the moment, again, on sort of the periphery, that are trading things aggressively, and it's bearing some watching. That partly explains why we had a little bit of a momentum correction over the last week. Some of those kinds of stocks and investors were shaken a little bit out coming into this earnings season. But I don't yet think that's risen to the level of being concerning for the overall market, something, though, that bears watching.
CPI report tomorrow.
Yep.
What would you expect to see there? Do you think, Justin, you could see anything in that report that might knock the Fed off course, or at least what we think is the Fed course, which is a cut? I mean, the market thinks that cut next week, that's a lock.
And I agree with the market. I don't think it's likely next week's cut is at risk. I do think tomorrow's CPI number has a lot of potential impact on the subsequent meeting and the path beyond October. I'd be a little surprised, actually, if the Fed cuts again after October. The economy is growing 2.5%, 3%. Inflation, we're going to probably see tomorrow, is still pushing 3%.
But you know, Jay Powell, he's concerned about that labor market.
He is, but that labor market is actually holding in relatively well, we think. Again, we don't have full data at the moment, but from what we can tell, especially at the higher end, and higher end consumers are spending well. Lower end consumers are hanging in, albeit with a little less confidence. I think he's more concerned about inflation and frankly, the whole Fed board than perhaps people realize. And I think he's also a little concerned about overstimulating an economy that's doing fairly well, all things considered, even if the jobs picture is a little bit muted. So yeah, if jobs get worse as we move through the balance of the year, that might turn around the odds towards a little bit more of a faster pace on cuts. But my personal bet is that after next week's cut, we might see a pause for a little bit in Fed activity.
I'm interested to get your take on inflation and the trajectory you see there, because some folks say, Justin, I've had folks sit in that chair and say they're just not that concerned, because they'll say labor market's cooling. They'll say, I see deflation out there. I see energy complex. Okay, oil jumping today on U.S. Treasury hitting Russia, but even so, I mean, WTI's at like 61, 62, gas prices falling, rents cooling. But how do you see it?
I still see some inflation. I wouldn't call deflation yet a focus. Tariffs are still having an impact. We're hearing companies right now in earnings talk about passing through some of those costs, depending on whether it's manufacturing or even consumer businesses. So there's definitely some inflation in the system. I think the consumer is going to feel that a little bit more as we move into next year. Not significantly, but noticeable. I also think that businesses have pricing power even beyond cost inflation. The economy is robust, and certainly a lot of parts of the economy, industrial companies, some technology companies, companies that were green on your screen a minute ago, are enjoying some unusual pricing power in different products and parts of their business. That probably continues, and that might also keep inflation at a little bit of an elevated level. This is why I think the Fed isn't as complacent on this topic maybe as the market believes.
Earnings season does roll on. Big tech and AI have been driving this bull market. I'm curious to get your take on that theme.
Yeah, still bullish. I still think that theme has a long way to go. I think the amount of money that needs to be spent to properly roll out the AI ecosystem and all of the associated power and infrastructure that goes with that is in front of us. The amounts of money that are being discussed are also financed. One thing people always ask me is, is this different than the tech bubble 25 years ago? Well, the companies writing the checks for all these big data center projects are, some of the best funded companies in the world that have enormous amounts of cash flow and cash in the bank. These are not speculative orders and contracts. These are take-or-pay contracts from fully financed companies that have a full intent and idea of what they're going to be doing 10, 20 years from now with these different assets. So I don't think that this is, in any way over. I do think you need to be careful at times and to make sure you're investing in and focused on companies that are properly positioned to benefit from the way this ecosystem is being built out. Again, I think there's some great companies in mid-cap industrials, for example, that help do engineering and construction and other pick and shovels elements that support this theme. So I don't just look at the theme as large cap tech. I think there are a lot of different ways to participate in it, but I think it has legs.
One other theme I want your take on, geopolitics. U.S. China, because now we know Trump and Xi set to meet next week. South Korea, I think it's going to be late Wednesday evening Eastern time. How, as an investor, you thinking through that?
It's a great question. I'll be honest. Right now, I'm still suspicious it's going to happen. But if it does happen, I'm very focused on, quite honestly, the Taiwan situation. I think one underappreciated risk to the equity markets is if anything ever did happen with Taiwan that would jeopardize sort of the semiconductor ecosystem, that is a major tail risk type event. So as an investor, I'm particularly concerned about sort of China-Taiwan discussions and relationships. Secondary relationship is then tariffs and sort of where they're able to hopefully break bread and get to a common ground on in terms of the tariffs in both directions. I don't like the way that things escalated on rare earths a few weeks ago. I'm glad that it seems to have walked back a bit, and I would hope that if they do meet next week, they're able to keep walking things back. So I'm optimistic.
There are some strategists who I hear say, listen, when it comes to Trump and Xi, their bet is you can get some huffing and puffing and some bad headlines. But at the end of the day, their bet, they tell clients, is you're going to get a handshake and a deal because the risk of not getting one is too great for both parties.
I largely agree with that. Yeah. I do think there's a lot of huffing and puffing. Handshake and a deal, we'll see. They're both master negotiators, and they both think they've got the upper hand. So I'm not sure we're quite to the point yet where they both feel they need to reach across the table and shake hands. So we might have a meeting that ends somewhat inconclusively. I don't think that's the end of the world for the equity markets if we end that position. I think the worst situation might be there's no meeting and there's more of a contentious discussion and we have to worry about incremental tariffs from two sides that don't want to yet talk. I doubt that's where we end up again. I think we have a meeting. I'm less certain on where we end up once the meeting occurs.
Justin, great to see you, especially on set. Thank you, sir.
You bet. Thanks.
Coming up, Wyndham Hotels get sent packing, hit by travel pullback in the U.S. We're going to explain more what's sending that stock lower today. We're also keeping an eye on Intel and Ford ahead of their earnings reports, which are coming out after the market close. We'll bring you the numbers as soon as they hit the tape. Stick with us. time for some of today's trending tickers. Yahoo Finance's Brooke DePalma. Joining me now for a closer look at Tractor Supply, Wyndham Hotels, and Molina. Going to start off with the Tractor Supply, the company topping comparable sales estimates for the third quarter, narrowing its full-year net sales guidance. So this one was interesting. So net sales for Q3, Brooke, looks like they increased about 7%. Same-store sales jumped 3.9%. I do see D.A. Davidson, the team over there that covers the name. I see them cited as saying, perhaps more importantly, they said the ticket size increased by 2.7%. They know the biggest increase in 10 quarters. We did mention it does look like they did narrow expectations for comparable sales and margins for the year, citing tariffs and consumer demand.
Yeah, and that's what the concern was that the 2025 guidance for net sales growth, they did say that it implies essentially a 6% gain for Q4. That would be less than what we saw in Q3. But other things that they noted was that these big tickets, this discretionary, those big ticket items, they're not necessarily rebounding the way that maybe some had anticipated in the back half of the year. For the fourth quarter, they do anticipate a comparable store sales range in the range of 1% to 5%. They said that reflects a wider set of possible outcomes given the current consumer environment. Also, those discretionary items, think items like recreational vehicles, grilling, safes, and generators, those sales continue to lag. So once again, just continuing to see this dynamic where consumers aren't necessarily going back to these big ticket items. But also keep in mind, this is a retailer that really dedicates himself, its consumer base is those rural communities. And we have seen this trouble that these rural communities have faced. Lots of farmers right now also getting hit. But we did see the Trump administration had said they plan to release over $3 billion in aid to U.S. farmers. One key thing about Tractor Supply is that these are reoccurring demand, though. Think like food, those usable items, things that essentially they need to refill their stock with. And so maybe that's good news there.
All right, moving on to another one. Wyndham Hotels, as the company slashes its full-year outlook and misses third quarter revenue estimates. All right, so actually the biggest intraday drop since March 2022, Brooke. And the culprit was, I think, reducing annual guidance. That'll do it. They now see adjusted EPS between $4.48 and $4.62. The stock, this is rough. It's at about 25% this year now.
Yeah, this reminds me a lot of what we have been discussing. Essentially, Wyndham really caters to a large array of audience. So we saw that luxury demand travel go up, and we saw some of their perhaps hotels that cater to a lower income audience. We saw that revenue per room really decline in this past quarter. Of course, keep in mind, they're behind hotels like Super 8, Howard Johnson, Ramada. So really just this array where they kind of got hit by this bifurcation that we're seeing.
Yeah, the stocks, listen, we said it's been rough. The street sees better days ahead. Broadly, I'm just looking positive on this thing. We got 14 buys, 2 holds, no sells, Brooke. No sells, no bears.
Optimism there, bullishness there.
Lastly, Molina Healthcare shares dropping as the company's earnings take a hit amid rising medical expenses. So this one, all right, in the red, they miss on EPS for the third quarter due to rising medical expenses, slash guidance for the fourth quarter. Now, thankfully, our colleague Jake Conley did a report on this. I say thankfully because this gets wonky.
It is pretty wonky.
It really gets wonky. But as Jake pointed out, the crux of the problem is this critical measure for healthcare providers, basically the ratio of premium revenue to medical expenses.
Yeah.
That's the issue, MCR.
And so what it really narrows down to is this